is that working in isolation 100% of the time, for those that have been virtual 100% of the time, really affects your career, affects your collaboration, affects your skill sets. That takes time to play out, but we're seeing more and more people want to come back, just not 5 days a week full time. So amenities, ease of getting to work, different ways to attract workers to want to be back together are the key strategies we're hearing from our office clients all over the country, and they're actively pursuing creative ways to do that.
What about also, so much discussion obviously about a recession, but whether or not at a certain point the economy would slow down in the next few years, when that could potentially happen, we don't know. But how much is that the catalyst? Because then you have more power when it comes to the employer, and if you are the employee and you're looking for a job, does that switch the dynamic?
Absolutely, because we've had no leverage as employers to mandate anything. Mm-hmm. You have to adapt to what the workforce wants in a 3.7% unemployment environment. Yep. If that shifts, of course, the dynamics will shift as well. But the one thing I really want to highlight is that there's so much coverage of distressed office space, putting more stress on the banking system, and a lot of headlines around that. And I wanted to really share with you and your audience that 24% of total bank outstanding loans are in commercial real estate, and 15% of that is in office. And a very large portion of that office loan portfolio is performing just fine. So do we have stress in the system? Absolutely. Is it going to get worse as leases roll over for office? Absolutely. But is it a threat to the entire banking system? The answer is no.
How about, if I want to go build a building somewhere in one of the growth markets, my cost of capital is much higher. Can I even get a loan for commercial real estate these days if I want to go build an office building?
The answer is yes, but you're going to pay a very high price for that debt. It's going to be underwritten so carefully. And as a sponsor, a developer, you have to have an amazing track record and an equity partner. It's happening very rarely right now. Part of what happens in a cycle like this is you get a big pullback in new supply. And thankfully, office hasn't had much new supply in the last 10 years. Right. Otherwise, this problem would be much bigger. But the construction loans are very difficult to get. Land is expensive. Yep. And materials and labor is also another reason, another deterrent to new supply. The other thing to share is the other segments of commercial real estate outside of office, apartments, even shopping centers, self-storage units, hotels. They're performing extremely well because they are aligned with a strong economy. We've had great job growth, very low unemployment. That is reflected in demand for all kinds of commercial real estate space outside of office.
And how does that compare when you're talking about the portion of loan portfolios? If you are looking at, say, retail apartments versus office, can that offset what we see with the issues when it comes to the office space?
I really believe that the heavily tilted loan portfolios toward multifamily apartments, they have occupancy of around 95%. Yeah. And even though rent growth has really slowed after 3 years of very robust above average rent growth, apartments are doing great, and those loans are performing just fine. We have a disconnect on the valuation of apartments, therefore sales activity, trading activity is way down because interest rates shot up and the lowest cap rate, lowest yield product type in the industry. So there's a big disconnect between buyers and sellers. The trading is way down, but the loan performance is just fine because the occupancies are high, and apartments make up the bulk of outstanding loans.
So if I'm a building owner and I got to refinance my debt, wow, that's a tough nut. I mean, what's happening in that market?
If your property is in distress, chances are the lender will work with you because the Fed and the Treasury have gone to the banks and said, work with your distressed borrowers. That's been the message to avoid a fire sale. Nonetheless, you're seeing some distressed sales come out of loan portfolios. There's no question about it. If you're performing well, if your asset is performing well, and occupancies are good, rent collections are good, there is financing available. But it means you have to come up with more equity. If you're upside down in the valuation and the loan-to-value ratios, depending on when you finance the deal. Now remember, most commercial real estate loans are 5 to 7 years in term. So 5 to 7 years ago, prices were a lot lower, and occupancies and rents were a lot lower. So should be plenty of margin, even with the
Who provides the equity? Who would I go to for equity? Is there private equity out there for just real estate? And I guess the question is, are they willing? I know some of these people now that I think about it, and they do quite well. Will they make that equity investment today?
Absolutely. There's plenty of capital. And one thing we're not seeing a shortage of is capital ready to pounce. And when we see prices that have adjusted from the peak to the tune of 10 to 25%, there's multiple offers on properties, even with the credit crunch that we're facing.
One of the questions, like I want to see, like in New York and in San Francisco, is I haven't seen anything trade. I think if you see a marquee building trade in Manhattan, is it going to be down 10%, 30%, 50%? I think those are the numbers we're going to be seeing, and we haven't seen that.
Right.
That's going to shock the market, won't it?
If it's an older office building, it's closer to the 50% you're talking about. If it's a newer asset with good amenities and great occupancies, it's going to be closer to the 10% you're talking about.
Wow.
What's the top question you hear from your shareholders?
How long will it take for this market correction to reverse, and what's the outlook for trading activity? Because our business as a leading broker of investment properties and financing of commercial real estate in the country, North America, I should say, including Canada, is all dependent on trading activity. And trading activity is down somewhere between 50 to 60% market-wide because of the buyer-seller price disconnect and very tough financing environment. And we think that once the Fed is done, which may be a little bit down the road, we were hoping that by now the Fed would really declare mission accomplished on inflation. I think we still have a little ways to go, but not far, because inflation numbers still don't reflect the drop in housing, the equivalent of housing costs, because they lag by about a year. So when the current leases roll over and the index for inflation shows the drop in housing costs, I think inflation is going to go down quicker. So I think we're very close to that end, and the ending of the tightening cycle itself will bring a lot of stability for both lenders on setting price and buyers, which are going to be borrowers essentially. And then put a little time on top of that with prices adjusting. Sellers are usually behind the market by a year and being realistic about what price an asset will trade at, because they're hoping for last year's pricing when the market has corrected. Both of those are starting to come together, but we're not quite there yet.
All right, Hassam Naji, thanks so much for joining us. Really appreciate it. Hassam Naji, he is the president and CEO of Marcus and Millichap, New York Stock Exchange traded company. MMI is the ticker, about 1.3 billion of market cap out there. So looking at the national brokerage commercial real estate, interesting time for that market, particularly in some of the larger markets. Again, I want to see some marquee properties trade in New York and see where that goes, guys. Just saw Billy Rudin on the Death Star earlier this morning talking about the commercial real estate market. That family is long NYC real estate. So see how some of that plays out. We'll take a look. S&P 500, we are pretty much flat on the day. Nothing happening out there. The Dow Jones Industrials also flat. NASDAQ off about 0.4%. So there you go on some of the big indexes. We're going to have more coming up. This is Bloomberg. Good morning. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Workers at a bankrupt retailer say they're getting gypped out of the money that they were promised. Bloomberg's Courtney Donahoe explains.
Some employees of Christmas tree shops are finding they won't be getting the bonuses that they were promised to stay on the job during the retailer's going out of business sales. Christmas Tree says it was due to miscommunication between the company and the liquidator hired to organize the sales.
Thank you, Courtney. A couple of airlines are looking to take advantage of strong travel demand in the Asia-Pacific region. Bloomberg's Steve Potisk has more.
This fall, Delta is adding 10 weekly flights to Shanghai Pudong International Airport from Seattle and Detroit. Meanwhile, rival American will add daily flights to Shanghai from Dallas in January.
Now, Delta shares right now, they are down about 1%. We have American shares down about 2% right now. And shares of CVS, they are falling. They're down about 9%. And this after the Wall Street Journal reported Blue Shield of California is dropping the firm's Caremark as its primary pharmacy benefit manager. The Blue Shield will work with a group of companies to streamline the system that Americans use to pay for drugs, looking to save millions of dollars in the process. All about the money. Tyson Foods reportedly exploring the possible sale of its China business. Now, sources tell Bloomberg that the process is still at an early stage and some private equity firms have expressed initial interest. But talks are still ongoing and Tyson could still decide to keep that asset. Now, profits of Tyson have really plummeted amid a supply glut of chicken and pork. Shares of Tyson right now, they are up about 2%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 11:20 on Wall Street. We check the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. Just listening to some of our guests here on Bloomberg Radio and on Bloomberg Television as well. Could see bond yields stay higher for longer. That's one of the themes that just keeps coming up among our guests today. The yield right now on the 10-year, 4.2999%. Guess we should call that 4.3%. We've got stocks lower. The Dow down fractionally, down 9 points. The S&P 500 also down fractionally, down 3 points. The Nasdaq down just about 0.5%, down 63 points. COMEX gold, it is higher, just up about 0.1% at $18.94 an ounce. Crude oil, one of the big movers of the day. We've got NYMEX crude right now up 1.8% at $80.85 a barrel. Also, Walmart, something to talk about, raising its annual profit forecast again, but striking a cautious tone, you might say, on consumers and the U.S. economy. Rising borrowing costs, and of course the clicking time bomb, which is the resumption of those student loan debt repayments. That, according to Walmart, could add to the strain on U.S. household budgets in the coming months. And remember, it's not just students. A lot of parents owe those Parent Plus loans as well. A lot of those, even baby boomers, owe those student loan. And so it really impacts everybody across the entire economy. And we will be getting results from Ross stores after the close. So that's a Bloomberg Business Flash. Paul and Jess, back over to you guys.
All right, Denise Pellegrini, thank you so much. We appreciate it. Jess Ment and Paul Sweeney live here in the Bloomberg Interactive Broker Studio. Live streaming the video thing on YouTube, so just head over there and search for Bloomberg Radio. That'll get you. So we got a lot of earnings. Tomorrow before the close, one of my favorite companies, Deere & Company, John Deere reports. I always like talking about the tractors.
Great way to get a sense of the economy.
Exactly, and the farm economy. So maybe we can get Chris Ciolito, he's the analyst at Bloomberg Intelligence. We'll get him on tomorrow to talk about the good friends at Deere. Right now we're talking about Walmart, and that is also another great read on the consumer. Their numbers, I thought, came in pretty well. Stock's kind of trading sideways.
Raised its annual profit forecast.
I mean, people are shopping at Walmart, and you can't. I mean, talk about a staple. I mean, they're just you can't avoid Walmart at all. Jen Bartashis, she covers Walmart. She's a senior industry analyst at Bloomberg Intelligence. Jen, what was a key takeaway from the results from our good friends from Bentonville?
Well, it really, when we look at Walmart, obviously they're on a roll, and they're continuing to draw consumers in. The messaging that we heard is that consumers continue to be a little bit conservative, but they're being selective about where they're shopping. And so they're saving on essentials, they're splurging a little bit in other areas, but Walmart has really positioned itself well to serve any customer that's coming through its stores with how they're offering value to those people.
All right, Jen, you taught me, or you let me know a couple of years ago, that the number one grocery chain in the U.S. is Walmart. I was shocked to learn that. Didn't even think about it. So if I go in to do my weekly shopping, do I then move over to the aisle and go buy some clothes and stuff like that? Does that really happen?
It actually really does, because part of what they're doing is they bring you into the store with compelling prices. People are going in to shop for groceries, and then on their way to the checkout, they see a T-shirt that's maybe $5, and they think, oh, well, there's some value, and it gets added into their cart. Or as they're looking to prepare meals, they're adding small kitchen appliances to help with the preparation of those meals. And so that cross-shopping into general merchandise is happening. And one of the things that Walmart called out is that even though general merchandise sales are still lower than last year, they're sequentially improved meaningfully from first quarter. And so that increase in momentum is actually really important as we get into back to school, when people will be looking for clothing and backpacks and shoes and things like that for their kids. So all signs point to a pretty good back to school season for Walmart.
Walmart is in the staple sector in the S&P 500 because that huge percentage of grocery sales, but so is Target. Okay. Target had been in the discretionary sector. Earlier in the spring, it did get moved into staples because of its percentage with groceries, but Target has a bit of a different story. It still cut its forecast, even though we saw improvements when it came to the inventories. What is it about Walmart? What is it doing differently that some of its counterparts aren't doing?
Well, I think the first thing is to just acknowledge the fact that Walmart's grocery offering is comprehensive. You can buy everything you need for a grocery shop at Walmart. That's a little bit different than at Target. Target's food strategy has been a little bit more targeted in that they were looking specifically for products that may have some sort of unique appeal or attribute. So Target never wanted to position itself as a place where you would go and do all of your grocery shopping. It was more of a place of look at these interesting things for discovery that are in the food area, some essentials that you need. But that difference in strategy is really showing now with the current economic backdrop and the way Walmart is acquiring more and more of the food shopping that's out there.
Hey, Jen, what is Walmart Plus, and how do Walmart Plus members, how do they shop?
So Walmart Plus is Walmart's subscription service, and it's similar to Amazon Prime for people who know that. And Walmart Plus is $98 a year. It offers you free shipping without any order minimum for things shipped to your house, but it also gives you free same-day delivery to your home from Walmart stores. And because Walmart is so big in the grocery business, membership has really been growing. It's been increasing. And in fact, we actually think that is a much underappreciated aspect of Walmart's business that's going to really drive sales and profit growth over the next 5 years.
We still have a lot of economists that are warning about the trajectory of the economy. When you
please,
look at Walmart's results, though, it's saying very much of a different story. What's your view of where the economy is headed when you have the world's biggest retailers signaling still some strength there?
Well, when we're looking at the economy in general, consumers are still under pressure. I think the advantage that Walmart has is that we are in a spot where we're seeing, for example, inflation on food come down. It's still high compared to 2 years ago, but it is starting to come down. And as inflation comes down, Walmart is able to very quickly work with their suppliers, lower their prices, and pass that on to customers. And so that is the backdrop is still quite conservative, and there are still a lot of consumers out there who have a lot of have to be careful with their budgets or being very selective on where they're spending. But Walmart's size and scale does position it well to take advantage of tempting them with even better deals as inflation starts to come down and people feel like they can spend a little bit more.
Jen, does Walmart open new superstores in America anymore? Or are they pretty much everywhere where they want to be?
It's pretty rare. They've slowed their new store growth where they're only a handful a year. Sometimes they're replacing old stores or relocating them, and then there are very targeted new openings that are happening. But the majority of their new store growth is happening in the international markets. For example, in Mexico, they're adding many new stores every year because they're still in a growth phase. They're adding new stores in China and in other international markets, and so. There is still CapEx for new store development, but it tends to be outside the United States.
When it comes to back-to-school shopping, which is the key driver in the current quarter, how do you view that as far as what that could mean for Walmart and other retailers?
Well, in terms of back to school, Walmart actually said that so far they're off to a good start, which is a little bit different than the sound we heard from Target, which was much more cautious, saying there were only a couple of days into the season and that they didn't have a good read on it yet. For Walmart, one of their strategies they've done in the past year as inflation has been really high is they've targeted bundles of things and kept them at prices that were the same as last year. They did that at Thanksgiving for the Thanksgiving dinner. They're doing that for back to school. So they have a basket of 13 or 14 most common school items, whether it's crayons or colored pencils, and offering them at the same price as last year as a bundle. And that can be very appealing to consumers. So they've very clearly been thoughtful in their approach on how they're going to handle back to school and make sure that they are attracting customers to what they have to offer.
I know we might be a little bit ahead of this, but any sort of early indications about the holiday shopping season?
Well, historically, the rule of thumb in retail is that if back to school is strong, holiday tends to be strong as well. Back to school is a very reliable precursor to how the holiday season is going. So by the time we get through this current quarter and we have an idea of the third quarter results, we will have a very good read into how we think the holiday season will play out.
Walmart stock at a all-time high here today. And they went public back in 1970. stock at an all-time high. Stevens & Company took them public, and Stevens & Company, good little investment bank in Little Rock, really good. They're still in business. Jen, is there any, what's the risk to Walmart? What's the risk to owning Walmart? Worst case, it's a GDP growth story.
Well, I mean, I think the risk is, potentially, the current management team has done a great job in shifting the entire culture of the company. But there are, we saw earlier this week some announcements of some management changes, especially at the heads of the different businesses. Doug McMillon appears to be ready to stay for a couple more years, but when that changes, there's always the risk that the company culture that he's worked so hard to instill will change. So that there is a risk. And then just because you're the biggest person in the room, there are always people coming, who have you in their sights. And so complacency, is the other real risk for Walmart.
Well, I mean,
and
the reality
they just need
is
to make sure that they're continuing to execute on all these different things.
Yeah, I'm not
that they're
buying any
doing.
of that. I mean, Amazon came in. And here's Walmart still hitting all-time highs. I mean, if they've shown they can compete against Amazon and that amazing business model.
So true.
I mean, you got to take your hat off. And that's why if you look at Rich Go, there are Waltons all over the Rich Go, which is the world's richest people. So they're doing something right, as is Jen Bartashis. Jen Bartashis, senior industry analyst at Bloomberg Intelligence, one of our absolute best analysts. And we appreciate getting a few minutes of her time. So it's a solid story.
Barclays actually at the beginning of this month raised their outlook for U.S. retail stocks for next year.
Oh,
and if you look at the XRT tracking retail stocks in the S&P 500, that's up about 14% since late May, doubling the S&P 500.
All right, with our news in New York City, here's Michael Barr. He's still here.
Paul, Jess, thank you very much. 11:33 on Wall Street. At least 111 people are dead from wildfires on Maui. In a pre-taped message for ABC's Good Morning America today, President Biden says he's been inspired by those who have helped their neighbors.
As one food bank worker described the resilient spirit that we're seeing, he said, "Nothing but aloha. That's all you see. That's Hawaii. That's America. And I want the people of Hawaii to know your country's with you as long as it takes."
President Biden and the First Lady plan to tour the devastation on Maui on Monday. There has been a surge in threats against people involved in some of the criminal cases against former President Trump. A Texas woman, Abigail Jo Schrei, is under arrest for allegedly sending a threatening voicemail to Judge Tanya Chutkan, who is overseeing the special counsel's election conspiracy case. And there are threats to some grand jurors in Georgia connected to the Fulton County DA's case against the former president. Southwest passengers heading from Houston to Cancun needed a mulligan to the start of their vacation. One of the engines caught fire shortly after takeoff, and the plane had to return to Houston's Hobby Airport. This woman was on that flight.
When the pilot came on and told us we were going back, he hardly finished that statement before he hung up the microphone. And, we were kind of like, what does that mean? What does that mean?
No one was hurt, and Southwest says all passengers were able to get to Cancun on another plane. Check that dehumidifier in your home. More than 40 models, including Kenmore and GE's, are being recalled after reports of fires and overheating. Global news, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 11:41 on Wall Street. We check the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. Stocks are lower. We've got some drama overseas. Sources telling us Chinese authorities are encouraging banks there to intervene on behalf of the country's currency. So there's some volatility potential, at least I should say there. Here in the U.S., the yield on the 10-year right now, 4.29, almost 4.3% higher on the day. And that means it might be time, you might say, to give credit where credit is due and maybe buy bonds instead of stocks, according to Troy Gajewski, Chief Market Strategist at FS Investments.
Cash and T-bills, T-bonds, T-notes are competition now for all other strategies out there.
And Gajewski with us there earlier on the Bloomberg Surveillance podcast. The Dow right now down fractionally, down 22 points. The S&P 500 also down fractionally, down 2 points. The NASDAQ down about 0.4%, 55 points we'll call it. That yield on the 10-year I mentioned, 4.29, close to 4.3%. Spot gold, it's up fractionally, $18.93 an ounce. NYMEX crude, it is up 1.71% right now at $80.75 a barrel. Shares of Walmart, they've been lower for much of the morning. Walmart boosting its forecast, but Walmart CFO sees uncertainty, also talking about student debt loads and what that'll do to shopping behavior. And guys, for those who do have money, how much do you think a small school should spend on its dining hall?
Oh, $10 million.
Jess, what do you think?
Oh, gosh, I have 15 million.
Okay, so Deerfield Academy up in Massachusetts, right, where they value education highly, as we know. They're tapping the muni bond market next week in order to renovate their dining hall, right? This is the Massachusetts Development Finance Agency that's involved. They're selling this $89 million revenue bond for Deerfield Academy. This will double the school's debt load. Now, the bond offering documents say the new dining hall supports the Academy's traditional sit-down meal experience, which is unique in this day and age, according to the bond offering documents. I will say some other prep schools do have nicer dining halls than Deerfield's. Well, this is just my opinion. And you know, all these schools had sports complex envy, right? Then they had science center envy. Now we have the dining hall wars. And Paul, I was at Duke lately. Yep. They do have a very nice dining hall and some really good food, too. And I wonder about Barry Ritholtz High School and yours, too, Jess.
I tell you, at Duke, it's dining halls, plural. And I'll tell you, if you want to see amazing new dining hall / field house / ice hockey rink, go Google the Lawrenceville School and take a look at what they just built, or just about finishing building, thanks in large part to the support of its alumni. So no municipal debt there. Denise Pellegrini, thank you so much. We appreciate it. Barry Ritholtz joins us.
Where is he? Why isn't he in
well, it's Thursday. He comes in here on Tuesdays to do his Masters in Business podcast.
I thought I was going to see him today.
And let's start right there, Barry. Who do you have on the Masters of Business podcast? Because you get an eclectic group of guests.
Yes, this week is Cass Sunstein, the Harvard law professor and author. I figured out his secret. Only co-author books with Nobel laureates. Dick Thaler, he co-wrote Nudge, and he co-wrote Noise with Kahneman, and his other best-selling book was on the world according to Star Wars. So he goes right to the sweet spot of the publishing world. Fascinating, insightful guy. One of the few people in the world of law focusing on behavioral finance. Just really interesting conversation.
Barry, I really enjoyed your latest column when you were talking about the issues if investors are focusing on one single data point to try to obviously make trading decisions on here. Walk us through what you were talking about.
Sure. We all have a tendency to get bogged down by recency bias. There's just a fire hose of endless new data points, new earnings releases, new economic releases, just on and on. Every day there's so much information, and it's very easy. The one that kind of got my goat this week has been the snapshot of the falling excess savings rate. And the problem, aside from the recency bias that we all suffer from, the problem is there's a tendency to just forget the broader context. And if you don't ask how did we get here, you have no idea of where we're going. So yes, excess savings has fallen dramatically, but you have to ask why. First, where did all that excess savings come from? It was a giant government transfer during the pandemic, about $1.5 trillion in unemployment benefits and lots of other government largesse from the CARES Act that ended up in people's bank accounts. And what a surprise. People with money who have cabin fever, they're locked in the house for 2 years.
Right.
When we open the doors, they go crazy. And it's just a lot of travel and a lot of spending and a lot of just pent up demand. And so if you look at it as a single snapshot, hey, we're all going to hell. But if you look at it as a film, as a moving picture, and you see where you came from, it's like, oh, this makes sense. People are reacting to the past. It was only a year ago we didn't know what was going to happen in the fall. Was there going to be another booster? Was there going to be another variant? Were we going to go back to lockdown? How quickly forget the previous circumstances?
When you do have a lot of skeptics, especially when Paul and I speak with a number of different economists that still think the economy is headed for potentially a recession in the next couple of quarters or so, how do you view where the consumer and the economy is headed when you're seeing a lot of other trends and data points that are pointing to other things happening here and more resilient strength?
Sure. So first, I think we have to stop focusing on a recession. Here's a news flash. There's always a cyclical economic contraction coming down the road. It's just how the business cycle works. We have expansions, we have contractions. The challenge is we never really know how soon they are on the horizon. So it's a little bit of a dodge to say there'll be a recession one day. We just don't know when. But at a certain point, you have to ignore the broken clocks who are saying, hey, recession's coming next month. All right, not this month, next month. All right, next quarter. And it's been a solid 2 years of this. And rather than just continually doubling down, I think a lot of these economists have to go back to their model and say, hey, this is wrong. This is a unique, unprecedented set of circumstances where we're moving away from zero interest rate. At the same time, we have several $1 trillion in fiscal stimulus. And so maybe the inverted yield curve doesn't mean as much as we think in this particular go round, partly because we were at zero for so long, and partly because you have the Fed raising rates so rapidly. That's what inverted the yield curve. Whenever people say it's a perfect indicator, the answer is always, hey, when was the last time it was a perfect indicator off of a decade of zero? And the answer is never. So again, it's all about not just focusing on a single variable, put it all into a broader context. Hey, by the way, if a single variable could tell you what was going to happen in the stock market, I think all the big hedge funds with their giant computing power and algorithmic excellence would be able to figure out, here's where the market's going based on this one variable, and it would be arbitraged away. You can't just rely on any one data point or even any one variable. The world is just too complicated.
Hey, Barry, I'd love to get your thoughts on China. Got a lot of kind of negative economic news coming out of there over the last couple of weeks. How do you kind of put that into your blender?
Yeah, so let's talk about more bad forecasts. What was it, 2 years ago, 5 years ago, 6 months ago? China is eating the world. The United States is going to be left behind.
August 2015 with the PMI data?
Right. They dominate us in manufacturing. They dominate us in AI. We're going to fall behind. And then it's a couple of months go by and it's like, by the way, China is collapsing. Their real estate is collapsing. Their banks are doing terrible. They're cutting rates. They're in a bad recession. Well, make up your mind. I think China is an important, obviously, very important economic player. I have no insight as to what their economic circumstances are like, especially when the government decides to stop reporting various data. That sort of lack of transparency. And by the way, China has never treated outside investors fairly.
No,
if you're a U.S. investor in China,
Yep.
You're always at an enormous disadvantage.
Yep. And we saw that, most recently with Alibaba. All right, Barry, got to let it go there. Barry Ritholtz, host of Masters in Business for Bloomberg Radio and Ritholtz Wealth Management. Let's get some company news right now with Lisa Mateo.
Good morning. Walmart raised its annual outlook for a second straight quarter. Its CEO says the company is in good shape with inventory, and they're pleased with their position on the back half of the year. But shares, well, they're lower this morning. Bloomberg's Abigail Doolittle explains why.
One reason could be the shares really priced for perfection. Coming into today, the stock was up on the year by more than 10%. Its closest competitor, Target, down more than 10%. So investors might have wanted a little bit more, even though this was a very clean quarter and a nice guide.
Well, Walmart shares right now down about 1%. Sinclair Broadcast Group accused of wrongly siphoning more than $1.5 billion from a local sports unit that filed for bankruptcy this year. Bloomberg's Gina Cervetti has more.
The subsidiary Diamond Sports Group runs local sports channels under the Bally Sports brand. A Sinclair spokesman previously said the allegations in the complaint lacked merit and that the company intended to vigorously defend against them.
Thank you, Gina. Weight loss drugs are all the rage, as you know, so much so that the Wall Street Journal says more than 50 websites are selling knockoff versions without a prescription. They're selling the raw ingredients in brands like Ozempic, Wegovy, Mounjaro that cost less. They're targeting people on social media, boasting about the cheaper price and pharmaceutical-grade quality. But they add that the products are for research purposes only. Now, the FDA is saying, don't fall for it, don't buy them. Now, we're going to check in with a few makers of those brands right now. We have Novo Nordisk shares. They're up about 0.9%, almost 1% right now. Eli Lilly shares down just a fraction. Those are the stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Jess Met and Paul Sweeney live here in the Bloomberg Interactive Broker Studio, looking at these markets right here. S&P 500 off 0.1%. The Nasdaq off 0.4%. Yields moving higher. 10-year yield up 6.5 basis points, 4.31% on your 10-year. The 2 years at 4.98%. So dangerously close to that 5% yield. WTI crude oil, it's up 1.5%, continues that volatile trading. Let's call it $80.59 per barrel. With our news in New York City, here's Michael Barr.
Paul, Jess, thank you very much. 11:56 now on Wall Street. The death toll from the Maui wildfires is officially at 111, but officials say that number could go up as they search more areas. People on the island are doing what they can to help one another. In a pre-taped message for ABC's Good Morning America today, President Biden says that the federal government is dispersing numerous resources.
The entire nation is with you as you recover, rebuild, and grieve. You know, as you seek to heal from the loss of family and friends, homes and businesses, and the native Hawaiian history gone forever. But we'll be with you for as long as it takes, I promise you.
President Biden says that he will travel to Maui on Gillen's family is thanking Blinken, but says that there's no movement in the case right now. President Joe Biden is preparing to host his first Camp David summit with South Korea and Japanese leaders tomorrow. Meanwhile, the United Nations Security Council held a meeting today to discuss what they believe are growing concerns on North Korea's human rights record. UN Human Rights Chief Volker Turk says as the country becomes more closed off from the modern world following the COVID-19 pandemic, citizens are becoming more despondent.
According to our information, people are becoming increasingly desperate as informal markets and other coping mechanisms are dismantled, while their fear of state surveillance, arrest, interrogation, and detention has increased.
The UN's Volker Turk says his office has recorded an increased rate of repression of fundamental rights for many of the North's citizens, including forced labor service and widespread hunger. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr, and this is Bloomberg. Paul, Jess.
Thank you, Michael. We appreciate it, Jess Mitten. And Paul Sweeney here in the Bloomberg Interactive Broker Studio. And Paul, this is my final few minutes with you before Simone Foxman comes in, as we are filling in for the Matt Miller, who allegedly is not feeling well today, but always a blast being here with you. But I wanted to point out and give a shout out to Carmen Renicky, who you know, Paul, is one of our great reporters on our U.S. equities team. She did a story on the terminal how a $400 putter maker plunging 85% after surging in its stock market debut. This is Saks Parente Golf. This is ticker symbol SPGC. It's down another 16% today, but looking at the valuation, it was around $63 million in the stock market value. If you look at that compared to Topgolf, that was valued around $3.1 billion. So really dwarfing some of these competitors here, but it's one of the most top-read stories on the terminal today, and I really thought it was interesting. Your thoughts when it comes to some of these golf peers?
I mean, people, I am a golfer, and I can attest, people will pay crazy amounts of money to get the latest technology. And by the way, the technology changes every year. It's a scam. We all know it. Nothing really changes except for like maybe over a 5-year time frame. So, but people go out there and they will spend crazy amounts of money to buy the newest driver, and in this case, the coolest new putter. And it's just amazing. So, but you know, was this a SPAC deal?
Oh, so this, I think, may have had some implements of that, but this is more just when you're looking at what's happening in that particular space, really taking off. But that valuation at $63 million, I mean, that's crazy.
It's crazy. All right, we'll keep an eye on that. And I haven't, bought stuff in a while, but the price tags on those things are just crazy. All right, we're going to have more coming up. More Bloomberg Markets starts right now.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to take a look at some of the data coming out of China. We'll do that with Jennifer Welch, Chief Geoeconomics Analyst at Bloomberg Economics. She's got some thoughts there. Then, the big man himself, Matt Winkler, the founder of Bloomberg News. He's editor-in-chief emeritus now. He's going to come in with his column on San Francisco, because I got a bunch of questions about one of my favorite cities in the world, San Francisco. Then Don McCree, head of commercial banking at Citizens Financial, will join us in studio to give us a sense of kind of what he's hearing out there, what he's seeing out there from his clients from a banking perspective. But guess what? Let's start this whole thing off right now with Charlie Pellet.
Hey, thank you very much. And here's what's going on. Stocks lower across the board. The Dow, the S&P, NASDAQ are all declining. S&P right now, I'm going to call that little change. It is down less than 0.1% right now. The S&P lower by 3 at 44.01. We've got the Dow down 41 now. Drop there of 0.1%. NASDAQ, the composite index, down 48 points. Drop there of 0.4%. Tech heavyweights dragging on benchmarks with stocks poised to extend a slump into a third day. A global bond market sell-off is intensifying among some of those big tech names. Apple shares down now by 1.1%. Tesla down 0.6%. Meta Platforms down 0.8%. Last night we heard from Cisco Systems. Cisco shares, they're up now by about 4%. Walmart has raised its annual profit forecast for the second straight quarter after scoring new sales gains with bargain hunting shoppers. Jen Bartashis is a senior analyst at Bloomberg Intelligence, and she was interviewed right here on Bloomberg Markets.
Walmart had a very solid quarter. I think most people expected Walmart to do well, given the current consumer environment. And really the key takeaways to me were that not only are they doing well in what we expected, which is grocery, but also that they're doing better than expected with general merchandise. And that's really important as we're headed into back to school and the holiday season, when people will be spending on things other than just food and essentials.
And you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Walmart, again, lower now by 1.6%. After the close of trading today, we will be hearing from Applied Materials. 10-year yield, 4.30%. We've got the 2-year yielding, 4.97%. Spot gold down $1.80 the ounce right now to $18.90, a drop there of 0.1%. And West Texas Intermediate crude up 1.6%, $80.65 a barrel. So again, recapping here, S&P 500 index down 4, little change, down less than 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate it. Simone Foxman joining us here.
Hello, hello.
Awesome. Bloomberg television reporter. She's joining us here for the next hour. The revolving door continues. You never know who's going to walk through the door, darken the door, but we got Simone for the next hour, which is a good thing. And she joins me. We're here in the Bloomberg Interactive Broker Studio. We're live on YouTube. So just go over there and search Bloomberg Radio, and you'll get to it. Looking at the markets, Charlie just kind of told you, not much going on the index level. Let's see what's happening with some individual names, and we do that with Bloomberg's markets reporter, Alexandra Semenova. Alexandra, what are you looking at?
Paul, Simone, great to be on with you. A stock that I'm watching right now is CVS Health. Shares are down nearly 10%. That's its biggest intraday drop since October 2022. And this is after the Blue Shield of California, one of the state's largest insurance companies, said that it is dropping CVS's Caremark business as its primary pharmacy benefit manager. That news comes from a big report from the Wall Street Journal. Apparently, this is part of a broader effort by Blue Shield to streamline the very complicated system that Americans use to pay for drugs with the goal of saving millions of dollars in the process. That's according to multiple interviews done by the Wall Street Journal. The insurer is apparently exploring different alternatives involving companies including Mark Cuban's Cost Plus Drugs and also Amazon. Amazon's foray, of course, into the drug supply chain has been dreaded by pharmacies and drugstore chains. This has been a big concern. This is also weighing on shares of other health insurers, Cigna, United Health, Humana, all moving lower today.
That's so interesting. You know, CVS has really been trying to push into its medical business and that vertical, and yet this appears to be a step
and Amazon.
in the right
It just scared. I don't know anything about how this healthcare money works. It's all crazy math. But anytime Amazon.com gets into something like that, and that's why I guess, as you mentioned, Alex, some of these other names also trading down as well.
Right. I'm sure investors saw Amazon, and that is really what is driving the stock lower.
Exactly. What else you got for us?
So another name, as Jess mentioned earlier, is Saks Parente Golf. This is an interesting one. Shares are down about 16% today, but that's not even the most interesting move. Yesterday, shares plunged 85%, and that's after they surged 624% on Tuesday in the first day of trading. That was the best initial public offering on a U.S. exchange this year, though obviously proving to be very fleeting. This is the maker of $400 golf putters. The listing is, of course, also the latest sign that we're seeing a revival in stock listings following the IPOs of companies including Oddity Tech, Spoiled Child, and of course, Kava Group. Although, speaking to my sources, they're still saying that deals aren't really happening. Brian Belsky over at BMO Capital Markets spoke to him on the phone a few weeks ago. He said, "We're scared of our own shadow. Deals actually aren't happening at the speed that people think they are. The IPO market has been showing signs of revival, but still not quite back to where it was."
You know, I'm just looking at this. This symbol is SPGC, Saks Parente, which is an odd name, but whatever. 3.2 million shares offered at $4 a share. The underwriter was the Benchmark Companies, which is a small investment bank. So IPO'd at $4. I don't know, went up to like...
Went to 32.
Yeah, almost 30 bucks a share. Now we're down to just under $4 a share. So I have no idea what happened there from a trading perspective, who got the stock and what they did with it. But that is really unusual. And I would just argue that is completely not representative, I think, of the IPO market right now. Let's look. We've seen some bigger deals, much bigger market cap, much bigger number of users that have traded very well this year.
Is this a meme stock, sort of?
It looks like it just IPO'd, and then I don't know what. Again, I don't know what happened on the trading, who got the stock, and then kind of what they did with it. Kind of an odd one.
In the IPO market is probably kind of leading to some of these meme type trades because it's such a rarity to see these companies debut, and so investors are piling in, piling out. We're seeing some abrupt moves there.
Yep.
Yeah, what stuns me, $190,000 of sales from last year.
Right, so this is kind of a startup type of situation. All right, very good. Appreciate it very much. Alex Semenova, she covers all the markets for us. Again, probably one of the bigger news coming out, over the last several weeks. It's just been this seemingly kind of never-ending or continuous flow of negative economic data coming out of China. Obviously not good for them, because remember we started the year, and this was going to be a good year for China. Reopening was kind of the theme, and how do you play that, and what would it? And we're just not seeing it.
Yeah,
in the
then there
data.
was the downgrade in terms of the expectations for GDP growth, and then, oh wait, the property crisis is still escalating, or it's still very much alive, and then, all this tension, geopolitical tensions.
Yep.
But we're going to sort this out, right?
Yeah, we're going to work this out right now with Jennifer Welch. She's a chief geoeconomist for Bloomberg Economics. She joins us from Washington, D.C. First, Jennifer, thanks for joining us. Please tell me what a geoeconomist is. That's a new term for me.
Thanks so much for having me. Yeah, it's a term we're still defining, but essentially we look at the intersection of geopolitics and economics. So, for example, geopolitical developments with economic impacts and the use of economic tools to achieve geopolitical ends.
Dave Dwyer thought of that. It seems a little above his pay grade. All right, Jennifer, so what do we think about China here? The economic data, I don't know, it just doesn't seem very good, and I guess it seems disappointing relative to maybe expectations.
Yeah, no, I think that's a really great point. I would say from a geopolitical perspective, and this is a piece we put out recently, I think we shouldn't over-exaggerate the impact that this will have on China's geopolitical importance or exaggerate the effect that this will have on their foreign policy. There's a history here of rising powers lashing out when they feel they've hit their economic peak or when they're feeling sensitive about economic challenges, and we don't necessarily see that happening with Beijing. I think at the same time, we should expect that they'll be more defensive when they do feel challenged. But again, we're not looking at a major foreign policy crisis on the horizon as a result of the latest economic data.
You know, we had an interview with the front runner in the presidential race in Taiwan, who is, I guess, seen as a little bit less favorable of a candidate with respect to China. I mean, can you weigh in on how China's economic woes are influencing that situation, particularly, especially because it's so close, because the tensions with Taiwan just being so physically close to China?
Yeah, sure thing. So I think you're referencing the recent interview with Taiwan's vice president and leading presidential candidate Lai Ching-te, who is actually just wrapping up a transit back through the United States on his way back to Taiwan. Lai is definitely not Beijing's preferred candidate. They've made that quite clear, including in their pretty strongly worded responses to his recent transit. This is despite the fact that it's pretty common for Taiwanese vice presidents and presidential candidates to come through the United States. In this case, Lai was on his way to Paraguay for the presidential inauguration there. Lai is ahead in the polls. It's early days still, but he does look to have a pretty strong lead for the elections in January. And I think there's a real question of how China would react to a Lai victory should he emerge at the top when the election's held in January.
Hey, Jennifer, can you give us a sense of how this administration kind of views or would like to see the relationship with China go over the next several years here? Is it one of engagement? Is it one of limited engagement? Is it one of just shunning China and letting them kind of deal with themselves? What's the approach?
Sure. So I think that the term is strategic rivalry, and the common catchphrase is, intense competition requires intense engagement. So we're likely to see both of these things. And frankly, I think the paradigms of the past of it's either engagement or it's hawkishness don't really apply anymore. I think the administration is trying to balance both of these features, with trying to engage Beijing, as we saw from Secretary Blinken's visit, Secretary Yellen's visit, discussion of Secretary Raimondo heading out this month, with continuing to take actions from the administration's perspective that are aimed at, defending U.S. interests, for example, rolling out the most recent outbound investment screening regime.
I mean, when you think of the struggles that China's economy is having right now, how does that change the dialogue in the Biden administration, in the White House, about how tough to be with respect to some of their geopolitical issues?
I think from a political perspective, this is a pretty good look for the administration. For the first time in many, many years, the U.S. GDP growth seems to be outpacing China's, and that's a pretty exciting story. I think from a foreign policy perspective, I don't see this changing in a major way, the administration's approach. Again, I think that's based on fundamentals that are unchanged here. China is going to continue to be a major power to be reckoned with. For example, they still have plenty of resources to put towards their military modernization, their technological advancement, et cetera. So I think the broad arc of the strategy is going to stay the same, but I would imagine there'll probably be some celebration about the recent economic data and how that shows how the administration's handling the U.S. economy.
It's interesting, Jennifer, I kind of feel a little bit of a dichotomy here, trying to take a tough government stance against China. There was some executive order last week to that end on the technology side. Yet it just seems like a parade of U.S. CEOs making their way over to Beijing, whether it's Elon Musk or Tim Welch or Jamie Dimon. I guess it's a kind of a fine line everybody's trying to walk here. We want to be tough against China, but we got to do business with these folks.
I think that's absolutely right, and I think that's contributing to a slightly more sophisticated discourse on what the future of the U.S.-China economic relationship looks like. The conversation around decoupling is largely seen as a pretty infeasible task, and now there is increased conversation about how do you, quote-unquote, de-risk? How do you kind of carve out the areas that you're most concerned about? And by the way, this applies on the China side as well. They have certainly been concerned about over-reliance on U.S. technology for some time now, even before the latest U.S. moves to restrict their access to it. So I think that's going to be part of the conversation going forward is how do we maintain an economic relationship that benefits both sides while still preserving each side's perceptions of their national interest.
How do you view some of the, I guess, it's maybe unfair to call it unrest or anything like that, but the dissatisfaction among the population with, well, boy, we put our money into these apartments, or we're not seeing the return, we're not seeing payments on our investments. I think, you know, there's to some degree, at least a certain segment of the population feels a little perhaps betrayed by what's happened with respect to some of the economic situation that's been going on. How do you view the population and their reaction?
I think that's a really important question. I think it's especially important for youth, right? Many of whom are emerging from college and looking to land their first job, looking to find, you know, their first home to live in, start to kind of acquire assets. That's a really important part of you know, sort of the cycle of life there, having property in your name as you start to build out your own life for yourself. And I think people are starting to feel sort of a major difference between the situation of growing up in the 90s and the early 2000s and 2010s as China was on the ascent and livelihoods were significantly improved from prior generations into perhaps what is going to be a new mode of, as Beijing would put it, high quality growth rather than necessarily focusing on the top up GDP numbers.
You know, it's for a while there, again, as you mentioned, back in those time periods, it seemed like China was opening up, and that was a good thing for the world. Is it now simply the fact that Xi continues to be even more firmly enhanced, that doesn't necessarily need to do that anymore, and he can kind of go back to maybe what his natural inclination was, which would be a little bit more closed?
I think Xi's dual circulation policy is a really interesting example of kind of the twin paradigms that they're trying to hit here, of one, not necessarily being overly reliant on foreign technology for fear that access to that could be cut off, right, as they see recent U.S. moves as kind of indicative of that perception being valid, while at the same time recognizing that in order to continue growing, in order to kind of beat the middle income trap, China needs to continue advancing technologically. And right now, a lot of that sort of superior IP and technology exists in other economies that they need to learn from. So I think that's the thrust of his approach, is trying to balance and make that bridge without becoming overly reliant on what he sees as being a risky sort of proposition.
All right, Jennifer, thanks so much for joining us. Geoeconomist, I like the term.
I love the term.
And I like Jennifer Welch. You're going to be coming back here. You got new friends at Bloomberg Radio. Jennifer Welch, Chief Geoeconomist for Bloomberg Economics down in Washington, D.C., trying to kind of get a sense of what, you know, geopolitics, economics, they certainly have, they certainly influence one another, and that's kind of what I think Jennifer Welch and Bloomberg
So many
Economics.
interesting data points and headlines recently. The latest one, China, please visit shadow bank investors at home to quash unrest.
There you go. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning. Wireless carriers are losing billions as demand for smartphones slows. Bloomberg's Jeff Bellinger reports.
AT&T, T-Mobile, and Verizon collectively lost nearly $5 billion in equipment sales over the last 12 months compared to the previous year. Executives say a lack of new devices from smartphone makers is part of the problem, and they note customers are waiting longer between upgrades. T-Mobile's equipment revenue fell 23% last quarter, while AT&T's slipped 7%, and Verizon's postpaid phone upgrades dropped 34%.
All right, checking in now with shares of AT&T down about 0.4%, Verizon down nearly 1%, and we have T-Mobile down 1%. Well, a couple of airlines are looking to take advantage of a strong travel demand in the Asia-Pacific region. Bloomberg's Steve Potisk has more.
This fall, Delta is adding 10 weekly flights to Shanghai Pudong International Airport from Seattle and Detroit. Meanwhile, rival American will add daily flights to Shanghai from Dallas in January.
All right, Delta shares right now down about 1%. American Airlines shares down nearly 2%. And watch out, Barbie, Hasbro is launching a new division called Hasbro Entertainment. Variety reports the move will unify the company's film, television, animation, and digital media business. Now, Hasbro is currently developing, producing over 24 projects based on Dungeons & Dragons, Transformers, G.I. Joe, and more. It says it wants to push the envelope with innovative storytelling that's going to let fans engage with their brands like never before. Shares of Hasbro right now, well, they're down just a fraction. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index just moving higher, up now by half a point, up barely at 44.04. We've got the Dow remaining in the red, lower by 33 points, down 0.1%. Nasdaq down 32, a drop there of 0.2%. Tech heavyweights are dragging on stocks as they are poised to extend a slump for a third day. A global bond market sell-off is intensifying. Right now we've got the 10-year yielding 4.30% with a 2-year 4.97%. Spot gold down $1.50 the ounce to $18.90, drop there of 0.1%. West Texas Intermediate crude up 1.8%, $80.84 a barrel. Well, as for the overall U.S. economic backdrop, Carl Riccadonna is chief U.S. economist at BNP Paribas, and he was a guest this morning right here on Bloomberg Markets.
There is a theme of resilience here, whether it's the labor market or consumer activity and whatnot, but you always have to be looking forward, and you're hearing those anecdotes of price sensitivity from consumers. So, the real test will be, if this can hold out over the course of the quarter, or if July just happened to be a good month for retail.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Tapestry shares are higher. Profit and revenue forecast for its current fiscal year came in below estimates days after announcing its acquisition of rival Capri Holdings. Again, recapping a 1-point gain, little change right now in the S&P. We've got the 10-year yielding 4.30% with a 2-year 4.98%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Simone Foxman, Paul Sweeney here in the Bloomberg Interactive Broker Studio, and we are YouTubing this thing, so just go over there and do the Bloomberg radio search, and that'll bring you the right to us. Matt Winkler joins us, the founder of Bloomberg News way back in the day. He's got a column that I've been waiting for him to write because I am a huge fan of San Francisco, as I've said many times, and I'm sad that it's on some tough times, and I haven't been there recently, but just kind of what you read and see and all that kind of stuff. Matt's got some analysis that says maybe it's not that bad. Matt, what did you find when you went out to San Francisco? What do the numbers tell you about one of my great favorite cities, San Francisco.
So I have to thank my wonderful colleague Shinpei for this, because we talked about San Francisco and what we decided to do, and he did specifically, is compare the 10 largest companies, publicly traded companies, in the 10 largest cities of America. And of course, San Francisco is not one of the 10 largest cities. It's number 17 with a population of, maybe 850,000. The 10 companies that are publicly traded that are 1 to 10 in San Francisco literally outperform by employee growth and sales growth over 5 years, all the way through 2025, the top 10 cities of America. So if things are bad in San Francisco, the business of San Francisco, the business people of San Francisco are thriving. And you can't, have two narratives like that at the same time. Something has to give.
But are these companies hiring the people there specifically?
Employee growth within the city limits.
Within the city limits.
Yeah. Totally outperform Chicago, New York, Dallas, Houston, every city except, by the way, close number two is Los Angeles. Okay.
Yeah. Well, that's your bullish California call that you've been making,
right?
For a long time.
And that's another column.
Yeah,
Los
that's
Angeles.
Exactly right.
But San Francisco is in fact a 21st century economy, as measured by the companies that it keeps. And I say keeps, I mean whether it's Visa, which is a financial company, or Airbnb or Salesforce, to name three. Airbnb and Salesforce right now are outperforming their global peers in market capitalization, sales growth, employee growth.
I know you spoke to the mayor of London. The mayor of San Francisco, London Breed. I mean, he's been there since. She's been there since 2018. So the good, the bad, and kind of where we're going now. What is her outlook?
Well, it's what you would expect it to be. She's bullish. I mean, and listen, London Breed is really exceptional in the sense that this is somebody who grew up literally in the worst part of San Francisco and was raised by her grandmother, and is, a success story in her own right. And when she talks about San Francisco, she's very confident, because guess who she talks to? She talks to the CEOs, and not a one of those 10 companies that we're talking about have any intention of picking up and leaving. And the fact that they're outperforming their peers in bigger cities, coast to coast, north to south, east to west in the United States of America, tells you something about San Francisco, which is probably why you like it so much.
Yeah, I do. And commercial real estate. Talk to us about the vacancy there versus other cities, because I guess the reporting suggests that
you've got vacancy rates that are maybe not as high as San Francisco, but close enough in lots of places, whether it's in Texas, whether it's in New York, whether it's in Illinois. Literally all across America, you've got, coming out of COVID-19, vacancy rates. Bloomberg News reported not too long ago that trend actually has gone favorable, in the sense that the worst is over and there's a rebound underway. So you would expect, by the way, that to happen, because more people are going to come back to work, even at Bloomberg. We're
return to office.
The owner has already told us that it's going to be a 4-day week at least in the office.
And our San Francisco office is awesome, by the way. It's built on one of those piers out into the San Francisco Bay. So again, kudos to our office people.
Well, to that end, so I actually was there for a reporting trip, I think 2017, 2018. I had gone as a child, and then I returned in early 2021, April 2021, I believe. And it was 2022, April 2022, it was pretty grim. Saw crime, saw overdose, the whole 9 yards. How, you've spoken with London Breed, how does what's the path forward from here? And does this really stand the potential? I mean, you see all these companies hiring and whatnot, but what do the executives say about how they are, making people want to live in San Francisco?
Well, the executives are very confident about their businesses because they talk about them from quarter to quarter to analysts and their shareholders. But I think what's more meaningful, and London Breed did reference this, is not too long ago, last month, in fact, what used to be called the Grateful Dead had a concert in San Francisco. It was sold out. Oracle was sold out. 120,000 people over 3 days into downtown San Francisco. And everybody had a great time, and it poured more than $30 million into the San Francisco economy. That's not a dystopia.
Mm-hmm. Right. Well, I mean, but do you see the change coming? I think there's specifically some rules about theft and burglaries resulting in misdemeanors rather than felonies, and this sort of encourages some
that's a
degree of
California
crime.
law, and there are some moves to change the law. There's a California law that actually makes it too often, you could say, a misdemeanor for breaking and entering or for burglary and theft, whereas in other cities, it's easily a felony. Now, that happens to be, if you like, an idiosyncrasy of California, and it's particularly acute in San Francisco, but that can be changed. Actually, the crime rate in San Francisco, violent crime rate, is way below most major cities. It's near the bottom, actually, among major cities. So that's a better indicator of really quality of life in San Francisco, I think.
One of the challenges for the San Francisco and the Bay Area in general historically was the cost of housing, the cost of living. Where are we in that regard now? Has there been an adjustment, or is that just California?
Everybody, especially London Breed, will be the ones to say they've hired more people over the years than they had housing for, and that it needs to be that inequality needs to be rectified. And it's actually being led at the state level by the governor himself to create housing, particularly public housing, in lots of places that historically have resisted it for local reasons. And the state is likely to circumvent those local restrictions once and for all so that you can have a big increase in housing, belatedly.
One of the stories I saw, Matt, just corporate conferences. San Francisco has historically been a great conference town because it's such a great town. Even that's taken a knock over the last
Well, there's going to be an Asia-Pacific summit in San Francisco.
That's right.
It's going to be a pretty big deal. Yep. And all the CEOs in San Francisco are going to be part of that Asia-Pacific summit because those companies are very much part of the global and, dare I say, Asia-Pacific economy.
Yeah, there's a stickiness to this, and then maybe negativity around San Francisco.
I just kind of feel like,
you see this data coming back. You see some of this data. How long does it take to sink in? You know?
Yeah, exactly. Well, all I know is that there's a ton of engineers there. You always need engineers. Matt Winkler, thanks so much for joining us. Matt Winkler is the editor-in-chief emeritus and the founder of Bloomberg News. Great columns. Shinpei, his man there with all the data, and they bring it. Right now, let's head down to, I don't know, where we go? Washington, D.C., we're going to go down to Amy Mars.
Nancy Lyons.
Nancy Lyons, even better.
Thanks, Simone. President Biden is issuing a message to the people of Hawaii as the death toll from the wildfires climbs to 111.
The entire nation is with you as you recover, rebuild, and grieve. You know, as you seek to heal from the loss of family and friends, homes and businesses, and the native Hawaiian history gone forever. But we'll be with you for as long as it takes, I promise you.
Biden's pre-taped message aired today on ABC's Good Morning America. The president and first lady will be traveling to Maui Monday. A disaster recovery center is now open at the University of Hawaii Maui College, where residents can connect to federal and state resources. The economic cost of this disaster could approach $7 billion. With concerns about China and North Korea growing, President Biden will be hosting a summit tomorrow with the leaders of Japan and South Korea. Bloomberg Government's Jack Fitzpatrick has more on what they're likely to to accomplish.
One goal is actually to set up a hotline for communication among those three leaders, President Biden, Japanese Prime Minister Fumio Kishida, and South Korean President Yoon Suk-yeol. Obviously, North Korea will be on the docket. Nuclear nonproliferation is something they have said they're going to talk about.
Jack Fitzpatrick says it's possible North Korea could even conduct a long-range missile test during the summit. A Texas woman is in custody and charged with threatening to kill the federal judge overseeing Donald Trump's trial on allegations he tried to overturn the 2020 election. The Washington Post reports the woman allegedly left a voicemail at Judge Tanya Chutkan's chambers saying if Trump was not elected in 2024, they were coming to kill her. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. A little change right now for the S&P 500 index, up by just 1 point. We have got the Dow Jones Industrial Average down 24, drop there of 0.1%. NASDAQ lower by 26. That is a decline of just about 0.2%. Bottom line here, we do have tech heavyweights dragging on benchmarks. Stocks poised to extend a slump into a third day. A global bond market sell-off is intensifying. We've got the 10-year yielding 4.30% with a 2-year at 4.97%. The Dow, as I mentioned, lower now by 0.1%. S&P little changed, up by a point. NASDAQ down by just about 0.2%. Spot gold down $1.79 the ounce to $18.89, a decline of 0.1%. And West Texas Intermediate crude oil up 1.5%, $80.61 a barrel. Well, as for the overall market backdrop and what is driving sentiment, Omar Aguilar is Chief Investment Officer at Charles Schwab Investments, and he was the guest this morning on Bloomberg Surveillance.
What we see at this moment is that the bond market is actually on the driving seat. We see that rise in yields. We see that continuation of inversion of the yield curve. We see every single sign of what the bond market seems to continue to confirm, that there is a recession potentially around the corner.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Well, among the names reporting today after the close of trading, we will be hearing from Applied Materials. That stock up now by just about 0.2%. Walmart, after earnings, lower now by 1.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Simone Foxman, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're doing the YouTube thing as well, so live stream there. Just head over there and search Bloomberg Radio. You know, a lot of economists are still talking about a recession. I am not buying it. I took it off the table a month and a half ago. I'm just not buying it. But I like to talk to people who are actually out there in the marketplace, talking to companies large and small, giving a sense of kind of what they're seeing out there. And we've got a great opportunity now. Don McCree joins us. He's head of commercial banking and vice chairman at Citizens Financial, publicly traded bank. CFG is the ticker. About $13.3 billion in market cap. Looks like it's been caught up in some of that regional banks downdraft there, off 28% year to date on the stock. Don, thanks so much for joining us here. What are you seeing out there? I mean, I think about Citizens. You guys talked to pretty much everybody, small businesses, mid-sized, larger companies. You compete against the big banks. What are you seeing out there from your clients?
You know, it feels pretty good. We're not seeing a lot of distress in the portfolio. I think companies are generally performing pretty well. I've said before that, you know, because of COVID, a couple of years ago, companies really tightened their belts. They got their cost bases down. They built their liquidity. They refinanced their debt. And so they're operating with strong balance sheets. They've had some of the things that had been plaguing them, like supply chain issues and things like that, seem to be behind. And a lot of the input costs that grew from inflation and the rapid changes of inflation have kind of subsided a little bit. So I think we're hearing pretty good things. There's absolutely a cautionary tone being flag being flown by a lot of the customers, just because there's still a lot of uncertainty out in the marketplace.
Right, and you wonder if companies have been preparing for a recession so long, if we don't see quite the depth of the recession that we could have seen, maybe they are just better able to prepare for it. I wonder, though, you know, credit is tighter. Do you see companies delaying transactions, deals?
It's been the demand for loans is definitely tepid. And I think a little bit of that, particularly new money transactions. And I think there's a little bit of a hesitancy to invest right now. There's definitely a little bit of a weakness in the leveraged buyout markets and some of the big transaction markets. M&A is a little quieter than it's been. And a lot of that's because valuations need to adjust, and buyers and sellers are still quite far apart. We tend to play in our investment banking businesses in the middle market. That's been a little healthier because the transaction sizes are smaller. falling. You don't have to raise massive amounts of capital to complete a transaction. And on the M&A side, it's a little friendlier from a government standpoint in terms of getting approvals for transactions. But I think regular way lending is okay, but it's not great. And I think that's more demand than supply, frankly.
Any stress in your loan portfolio at this point?
The commercial side's pretty good. C&I side, obviously real estate is the flashpoint, and office real estate is the place that we're all focused. We're working through the issues fine. We put a lot of disclosure out in the second quarter and kind of went through the portfolio. So, nothing that really is causing us to have sleepless nights, and we have an enormous amount of earnings power to basically absorb any losses that do come along.
Looking beyond yourself, there was a series of downgrades by Moody's on the regional banks. You guys saw your outlook cut, but that was actually a sort of positive thing. Right. Looking at your peers, what's the extent of the commercial real estate stress that you see? That was a particular point that was called out.
I think, like us, I think most of them are working through it. It's going to be a 2 or 3 year kind of working through any distress we have in the portfolio. We're having a fair amount of success restructuring loans that we were worried about. So we've taken a couple losses, but nothing too significant. And I think as I looked at earnings from our peers across the board, everyone said about the same thing that we said, which is, yeah, we're focused on it. Obviously, there's going to be stress in the office market, but there's a lot of equity in these deals. That's the first to go, and then any losses that the banks will take are going to be, small fractions of the overall exposure.
Yeah, I mean, we've seen some of these large private equity firms or real estate firms in particular, like walking away from poor investments. I mean, to what extent are you guys happy to end up with the asset at the end of the day?
Well, we generally won't. We generally won't end up with the asset. We go to great lengths not to end up with the asset. So we would probably sell the note or do some other kind of restructuring and bring in alternative equity rather than take down the asset.
Let's talk just about some of the regulations on your industry. More coming down. What are you telling your shareholders about the regulations, how they're going to impact you, and kind of what you're trying to do to get ready?
I think there's clearly going to be higher capital requirements. There's going to be stricter liquidity requirements, and we're preparing for those. We have been preparing for those long before the regulatory kind of talk about exactly what it's going to be started to leak out. So I think that our returns will be a little bit under pressure, but the benefit that we have is we have a really diversified business model with a lot of earnings power. So if it goes down a little bit, we're going to continue to be able to return capital to shareholders, and it's going to be an adjustment. But we've been through these kind of adjustments before.
You had some reporting on how U.S. regulators are going to propose requiring banks with as little as $100 billion in assets to issue enough long-term debt to cover capital losses. And then the head of the FDIC coming out and talking about how this bolsters financial stability. Do you agree, disagree?
At the margin, it bolsters stability, but we think that the banks are in really good shape. We think capital levels are quite high, better than a lot of other parts of the world, and well-managed banks have really strong liquidity profiles and really strong capital absorption capacity.
How's loan growth across your client base here? Because, boy, we've been shocked with these rise in interest rates. If you want to go out and get a mortgage or if you want to go out and finance some capital spending or finance an acquisition, what's loan growth like these days?
It's been kind of flattish for the last couple of quarters, and we're expecting a little bit here and there depending on the sector, but we expect reasonably low levels of loan growth for the balance of the year. Less on the that's on my side. The retail side we're having some pretty good expansionary growth in places that we're growing on the retail side in the retail portfolio.
Well, have consumers just adjusted faster? Do businesses catch up with them to a higher rate environment?
Yeah, I think we have to keep in perspective that where rates aren't that high, and from a historical standpoint. Mm-hmm. So I think the issue with borrowers has been the speed of the change in rates as opposed to the absolute level of rates. So yes, I do think that consumers and businesses will adjust to a higher rate environment, and I think rates are going to stay high for quite a period of time.
University of Vermont, big fan. 2 of my siblings went there. You're a big player. Give us 20, 30 seconds on UVM.
UVM is doing fantastic. The school is growing. We're very financially healthy. Great statistics. The major thrust we have right now is growth of our research programs, and we're basically getting enormous levels of research grants from a variety of businesses and governments, and it feels very strong up there. And Burlington is obviously a fantastic place to go to school.
man, my brother and sister went there. I'm like, why? And I had another brother go up to
beautiful,
St.
isn't it?
Michael's up in Vermont. I'm like, what are you guys thinking about? It's cold up there. So what do? I go south. Don McCree, head of commercial banking and a vice chairman, Citizens Financial, joining us live here in our Bloomberg Interactive Broker studio. We appreciate getting some of his time. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
You got it. Shares of Cisco Systems are on the rise after reassuring investors it can weather a spending slowdown. Now, its CEO Chuck Robbins pointed to headway in AI and security technology. Bloomberg's Ed Ludlow has more.
What Cisco said is that they'll be a leader in AI, but they gave tangible evidence that they're already doing that, saying that they booked $500 million in revenue already for their AI-related products.
All right, now shares of Cisco Systems right now, they're up about 4%. Well, the labor market in big tech is seeing a shift. Bloomberg's Gina Cervetti has that story.
After beefing up during the pandemic, the tech sector had some of the earliest and steepest job cuts as the economy slumped. Now, even though the companies are not yet ramping up hiring, cuts appeared to slow in June and July. Research from Jefferies and job marketplace TrueUp shows that tech cuts are also on track to be even lower this month.
And speaking of tech companies, a lot of them has joined the corporate effort to get employees back into the office. But there are some exceptions. Airbnb and the software company Atlassian say they support remote work. They say one big benefit is that it helps them recruit better talent. Shares of Airbnb right now, well, they're up just a fraction, and Atlassian shares right now down about 0.7%. And Tyson Foods is reportedly exploring the possible sale of its China business. Now, sources tell Bloomberg that the process is at an early stage, and some private equity firms have even expressed initial interest. But talks are ongoing, and Tyson could still decide to keep the asset. Shares of Tyson right now, they're up about 2%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, you don't see this very often. There's literally no movement in any of the stock indices, so I'm just going to leave it right there. So I said indices instead of indexes. So
That was nice.
Matt doesn't like it. It's because
it's
the Bloomberg
indices.
way is indexes.
Is it?
So I say indices
Should
just
have
to...
taken that up with Matt Winkler.
I know, just to
before.
take it up with Matt Winkler. But I will call out WTI crude oil. It's up 1.7% here. We're at $80.72. And the movement today is in some of the interest rates. 10-year Treasury up 6 basis points, 4.31%. The 2-year, we are on that 5% watch. It is 4.98%. I'm going to round up a little bit there. So keeping an eye on that. Rates continue to move higher. Right now, let's go down to Washington, D.C. World and National News with Nancy Lyons.
Thanks, Paul. President Biden will be hosting his first Camp David summit tomorrow with the leaders of South Korea and Japan. The focus will be on better communications and the ongoing threats posed by China and North Korea. Today, the UN Human Rights Chief Volker Turk warned the UN Security Council about the repression those in North Korea are now experiencing.
According to our information, people are becoming increasingly desperate as informal markets and other coping mechanisms are dismantled, while their fear of state surveillance, arrest, interrogation, and detention has increased.
Volker Turk says the people of North Korea are also dealing with widespread hunger and starvation. Hawaii Governor Josh Green says they're up to 111 known deaths from the recent wildfires, and search crews are continuing to look for remains in the ash. He says additional canine teams are on the way.
They are now up to 30 dogs. They'll move to 40. There's now going to be another about 225 relief individuals coming.
Green says access to hard-hit Lahaina will remain restricted while they search for the missing. The top White House lawyer, Stuart Dellery, is leaving his job next month. He was the first openly gay person to hold the position. He's also the one who helped President Biden navigate legal issues during the pandemic and during Republican investigations. Biden says Dellery has been a trusted advisor and an integral part of his team and will be missed. A successor has not yet been named. Over a dozen people who survived the racially motivated mass shooting at a top supermarket in Buffalo, New York, well, they're filing a lawsuit. They're taking action against social media companies, the retailer that sold Peyton Gendron his gun, and the company that manufactured his body armor. They're also suing Gendron's parents, claiming they took no action to keep him from getting a gun, despite being aware of his mental health problems. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Simone.
All right, Nancy, thank you very much. We appreciate that. We were just talking, Simone, to Matt Winkler, Bloomberg News founder, about what's happening in San Francisco and how they're trying to deal with some of the challenges there, including what to do with some of the vacant office space. Same thing here in the city. New York City is rolling out a plan to convert vacant offices into as many as 20,000 new housing units by creating a multi-agency group to help developers cut through red tape and rezoning a section of Manhattan known as Midtown South. That's going to be interesting because what I understand is it's very difficult just from a logistical perspective to convert some of these commercial properties into residential properties.
From a zoning perspective, from a physical perspective as well, but it looks like under this plan, which does, parts of which at least need state approval, the city would make office buildings built before 1990 eligible for conversion to housing. Previously, there was a cutoff for at 1961 or 1977, depending on the area, but now, wherever you are in the city, if residential construction is allowed, you can make that switch. I mean, I wonder who's coming out of the woodwork, though, to actually do the project.
Yeah, I mean, presumably, the demand is there. It's just a question of really what the cost. I mean, a lot of these, again, we've talked to builders in the past. They say, boy, this is no easy thing to do.
Yeah, the layout's all wrong. Yep. The windows are in the wrong place.
But you got to do something because, again, there's so much of, commercial real estate in the city, particularly in Midtown, which is vacant. And I don't know if it sells at any point, if it clears. If it doesn't, then you got to do something with it. So we'll have to see. But that's a kind of a big issue here for a lot of the big cities, including Manhattan, particularly here in Midtown Manhattan. Sound On with Joe Matthew, Washington, D.C. That starts right now.
Handle and $1 it's just a little bit softer. Getting through the market, so flipping up the board and taking a look at the bigger story of the day, which is yields, global yields, and treasuries across the curve. You're looking at a 2-year yield at about 4.97 on the day, essentially flat. But then if you look along the curve, the longer end of the curve is where you see the real movement here, and that is what is impacting markets. The 5-year, 4.44. The 30-year at 4.40. These are the highest levels since 2011. And the 10-year yield at 4.30, up about 5 basis points, at about the highest level since 2007. We're going to talk more about this bond market with Bloomberg's chief global macro markets correspondent, Liz McCormick. Liz, if you take a look at what's happening in the yield story today, explain the movement particularly at the long end of the curve here and the steepening that we're seeing today.
Yeah, I think that's been really the important thing, among others, this week, because it just seems like the long end can't get any good news to bring rates down, because you have the trifecta of course, the Fed is the base for everything, that this sense the economy is resilient, the Fed may stay higher for longer, inflation could be sticky. You have what we heard earlier this month, the barrage of Treasury issuance coming, already started, that's going to keep into next year because the deficit is so bad. I mean, Chanel, you have like in the minutes yesterday, besides, it sounding generally hawkish, the minutes kind of reiterated what Powell had flicked at during his press conference, that, hey, by the way, QT, quantitative tightening, so the rolling off of bonds from their balance sheet could keep going even if they start cutting eventually, which was always like, okay, that has to end. And that's another pressure on the long end of the Treasury market. So I think that is just the things just keep piling on. People want a risk premium to lock their money up with the Treasury for 10 years, 30 years. It's just not fair value now, they feel.
Liz, who is getting caught off guards in this scenario?
Well, I think, without naming names, some of the big asset managers, as we know, came into this year and just thought, okay, last year was brutal. The Fed is close to done. This is kind of, I hate to keep saying the year of the bond, et cetera, but, saying you should go long, go out the long end. And like we just mentioned, the long end is just getting beat up lately. So if you look at the Bloomberg on the IN page of our indices, as of yesterday, the U.S. Treasury Index was down for the year, and the U.S. Ag is about there, the global Ag, all these things are at least the best flat, and a lot of them are red. So I think some of the asset managers who came in, now they will tell you, like, Liz, chill out. We're in for the long haul. We're picking up great coupons. We're going to lock in. So they're probably right. But I'm saying at the moment, they may not be feeling so great, some of them.
Liz McCormick, thank you so much for your time. Another sector with rising rates is the housing markets, because mortgage rates have topped 7% in the United States, pushing affordability to the lowest level in nearly 4 decades. Brown Harris Stevens CEO Bess Friedman joins me to discuss. Bess, if you look at this kind of movement in mortgages, what is the ultimate impact you're seeing among buying trends that are most significant that maybe most people don't see?
Yeah, I mean, I think the rates going up so much has created this sort of potential buyers are sitting out and opting to rent. And I think also potential sellers are deciding not to sell because they don't want to refinance at these higher rates. But what you're seeing is a trifecta. You're seeing rates that are up. You're seeing inventory constrained in most of the country, not New York City, but a lot of parts of the country. And you're also seeing prices are still elevated. So that trifecta is creating a sort of sluggish housing market.
Let's talk about New York City for a second, because just before you got here, New York City had been announcing a new plan to roll out as many as 20,000 new housing units, and really rezoning Midtown from office buildings to a more residential place. How might this impact the market in the city?
I mean, it would be a great thing. I know the mayor's office has submitted this plan to do this whole rezoning so that we can do that. And we have a migrant crisis, as we know, so we could definitely use more housing in the city. Would be a great thing to do.
How are you thinking about pricing, not just in New York City, but over in the Hamptons? Because you look at this trend of people willing to pay pretty extraordinary prices when it comes to the luxury market.
That's right. That's discretionary. So discretionary is very different than the everyday buyer, because they have a lot of money at their fingertips. They can spend a lot. They don't care so much about rates because a lot of times they are cash. Cash is king. But rates have doubled, so a lot of people are holding back. But in the luxury market, in the Hamptons, Palm Beach, and Florida, for example, there's no inventory. Prices are high, and there's not a lot to buy there. And people are, if they have a lot of money, they're willing to pay a little bit more. But the everyday buyer is sitting it out for the most part.
Is it that the scarcity value here is making more people jump into the market, knowing that they're not going to get a place if they don't jump now anyways?
Well, I think people are trying, right now it's mixed messages, right? So we heard recession, and now they're saying, the Fed is saying, okay, or the economists are saying there won't be a recession, right? And inflation has come down, which is good, but I think it's a flawed assumption to think that because inflation has come down, rates are going to come down. I think rates will stay at where they are, and they probably might tick up a little bit. So I think we have to get used to this new 6 and 7% for the 30-year.
Well, interesting about the 6 and 7%, how much higher can rates possibly go? And at what point, to your point, the luxury market is so different from what you're seeing across the country. At what point does this really start to dent buyer appetite?
It has already. I mean, there was a report last week, I think, that the rental market in New York City has hit a high because, and this is my opinion, of course, that a lot of would-be buyers have decided that they want to rent versus buy. I have friends who were going to buy who reached out to me and said they're going to renew their lease for another year because they feel there's a lot of mixed messages out there. They don't know what's going to happen with rates, what's going to happen with inflation. Is the Fed going to now, the Fed fund rate is there going to be another increase? People just don't know what's going to be. So I think there's been a meaningful change in the economy, and we avoided a recession. Inflation has come down, but for housing, we're still in a sluggish market. We're not out of the woods yet.
You see an inventory issue across the board, and what would it really take for people to start listing homes again?
I think they would have to be able to get a good rate. I mean, they're not, if they have like a 2.5% or 3%, and now they're paying almost 7%, they're going to have to really decide that they want to move to a different place, and it would, it's really hard. Why would sellers want to give that up? I mean, I wouldn't want to. It's like low cost every month, and then you would be doubling your expense. So I think we're in a little bit of a holding pattern right now in housing. That's what it feels like.
How do you consider what the top really is here for selling prices? If you're looking to sell your home one day, at what point do you do it in the next couple of years?
I mean, you have to, I think that the market, I always say this, and I hate to say it over and over, but the market is there to serve you, right? You have to decide what your circumstances are. Do you need to sell? Are you moving? Do you want to go downtown? Do you want to go uptown? Do you want to change locations? Do you have a new job? All those things. Are you working from home? What is your situation? And then you determine what you need to do or what you want to do. I don't think you look at the market and go, oh, I think I'm going to sell. I think you decide for yourself what works, and then you go from there.
It's recently you've written that beating the heat is a good idea. Selling your home now is actually not a bad idea. Why do you say that?
I think that you can take advantage of what's going on. I think there are real buyers out there, and they're willing to pay if they can find the right home. And I think you could take advantage of less inventory on the market in August, for example, and maybe you can get a deal done. Because people typically don't list in August because it's the summer, people are away. But I think sometimes there's buyers, real buyers are out there, and you could take advantage of that.
How do you look at the New York City to Florida dynamic as it's playing out into this year? There was so much exuberance when you saw that exodus out of New York City, but you now also have a lot of people coming back.
That's right.
How is that?
I mean, I think we did see a lot of people move. We saw a lot of people move to Florida during the pandemic, Connecticut too, and I think we've seen people return. We hate when people leave New York City, right? It's not a good thing, but the return has been good, slow and steady. We have to look, the taxes have been a big reason why companies have also moved, have put their headquarters in Florida. And so, in Albany, they have to remember that. They have to think about that, the legislators, because we want to keep rich people here. It helps our city.
What about other parts of the country here? If you think about markets that you're most focused on, where would they be?
Well, we have offices in Florida, in New Jersey, Connecticut, and New York, the Hamptons. And so that's where our focus is and what we, really where our offices are and where we do a lot of our business. And so those are a lot of discretionary buyers, but we also do rentals and we do studios and one-bedrooms. And, the market has been a little bit slow.
What about New Jersey? You had mentioned kind of this movement to Connecticut, Florida, but where does New Jersey fall in all of this movement?
No, that's a place where there's tight inventory. Look at Montclair, New Jersey, Hoboken, we have offices. I mean, the agents will tell you they'll have an open house. There'll be 20 people. People are bidding on it, and things get done right away. So there's a place where you have constrained inventory. New York City, we have good inventory. Jersey, you don't. Connecticut is challenged, and Florida as well.
Constrained inventory.
Yeah.
Got to strike fast. That is Brown Harris Stevens CEO, Bess Friedman. Thank you so much.
Thank you so much.
Okay. Coming up, we're going to talk private credit with Raj Danda of Ares Management. This is up next at Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Markets, and I'm Shonali Basak. Private credit managers have been increasingly turning to wealthy individuals as a fresh source of funds. And over at Ares, out of the nearly $380 billion in assets, almost $65 billion is from the retail investor who's contributing anywhere from $2,500 to $1 million per investment. Raj Danda is the global head of wealth at Ares Management. Raj, thank you for joining us. I know you've had a lot of roles over the years when it comes to wealth as well as private investing, but we've been talking about this before with the market rebounding here. What is the pitch to private investors when they can just be investing in the S&P?
Yeah, of course, great question, and thanks for having me. I think there's arguably never been a better time to reflect on your investment portfolio. We have had an unprecedented move in interest rates, and investment characteristics from the alternatives market are incredibly important to dampening volatility and to really helping advisors keep their clients invested in the markets. So we think this is as great a time as ever to reflect on a 5% allocation to alternatives and really take that to a 50% allocation.
50%, that seems like a lot of your money tied up in an illiquid investment. How do you make that pitch to folks when they might want that money back sooner?
Yeah, I think you have to zoom out because the liquidity discussion is an important one. Today, we think a lot of individuals overpay for liquidity. The liquidity in their public markets is there to provide them the opportunities to get in and out of the markets. Most individuals barely have 5 or 10% in alternatives, and with 90% in liquid assets, they're actually giving up 300-400 basis points in excess return. And that's really the story. There's an opportunity to have a portfolio that is able to weather higher interest rates, inflation, and not overpay for liquidity.
Well, let's talk about some of those areas, because when you're talking about kind of beating inflation here and capitalizing on higher interest rates, private credit, floating rate, that has been the story of the year, whether you're a big institution or a private investor. So how much interest are you actually getting, and are they willing to kind of foot the bill when it comes to adding more to these investments today?
Sure. So for 25 years, private credit has been at the backbone of Ares and our growth. And so it's something that we have been with for a long time. And we have the scale and the flexibility, the incumbency to be a real leader in the market.
for the investors, the critical role that it's playing today is durable income. It offers today almost a double-digit yield, and it offers a defensive position, which most clients are looking for. They feel there's uncertainty, and they want some protection in the capital structure. So private credit flows have been the highest in the wealth channel for the better part of this year. They're growing as more managers like Ares can deliver the types of solutions that they're looking for.
And you think about kind of concerns, as much as people might be excited from 8 to 12%, depending on what manager you are, in that return space for private credit, people are also worried about defaults. There was a note out by Apollo the other day that kind of discussed the rising amount of downgrades relative to upgrades that are happening in the market. And you have to wonder what that looks like in a private market where the data is a lot less public.
Sure. One of the hallmarks of Ares is we build really diverse, durable portfolios, and we stay away from the more liquids, more cyclical sectors. So for the 2,000-3,000 companies we lend to, we're not seeing a lot of stress. We do know that as rates stay high for longer, there will be some challenges and some stress in the markets. But to date, we've seen actually companies we lend to putting together reasonably good returns.
How long do rates need to stay high for you to start seeing more meaningful cracks?
Well, I think if they stay high for 1, 2, 3 years, you'll start to see some stress in the system. I think there are more and more people talking about rates being cut next year. And so I think for that period, if that's what plays out, we're pretty comfortable with that.
What about real estate? Because that's another area where when you think about private investors, retail investors, high net worth, real estate has been a very popular area. And until this year, performance has been pretty booming. If you look at your own REIT, the performance has still been elevated, but it has dropped a bit. When does that start to turn around?
So commercial real estate we think of as a core asset class for wealthy individuals. I've rarely met someone who's built wealth over time without an allocation to commercial real estate. It's the third largest asset class, so there are parts where there's significant stress. You're in New York City, it's hard to miss the challenges in the office sector, but we see opportunities as well. Commercial real estate debt is an attractive opportunity where you get equity-like returns from being senior in the capital structure from a debt investment. Our areas of high conviction have been distribution warehouses on the coasts or apartments in some of the high-growth, low-tax Sunbelt areas. And in those areas, we are seeing strong cash flow. Of course, this move in interest rates, it's relatively unprecedented. It's happened very quickly. It will take some time for cap rates to adjust for a 500 basis point move in rates. But we think it's a core allocation that clients should build over time.
Especially because you have private markets looking to capitalize on some of those opportunities in commercial real estate. How does Ares view that opportunity? Is it there's some pain for a while longer, but we're willing to dip in and we're asking our retail investors to get in along for the ride?
Yeah, so we spend a lot of time on education, thought leadership to help this journey, as I say, from 5 to 50. And private markets have lots of different opportunities. We're talking about private credit today. Secondaries is an opportunity that we see a lot of interest in, which offers great diversification. So whereas the public markets are on the screen every day and provide some sort of feel for the sentiment of the investor, there's really a tremendous breadth of opportunity in the private markets.
You know, you and I were kind of joking the other day about how you could work from anywhere at Ares, so all of a sudden you live in Denver but are working here today. And so where are you working from? And for somebody that is kind of the epitome of, you know, not being in New York City, how many people are actually doing this?
So one of the advantages at Ares is we have offices around the country. LA is our headquarters. New York is home to many of us. Denver is an office. I'm headed to Massachusetts to be with my family later on today.
Very cool, Raj. Nice to see you in studio. Thank you for coming down and joining us. That is Raj Zanda. He is the Global Head of Wealth at Ares Management. Still ahead, why Wall Street's most hated 3 letters are proving too risky to ignore. This is Bloomberg.
2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on a size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
This is Bloomberg Markets, and I'm Shonali Basak. Investors and bankers are avoiding saying ESG in meetings with clients, according to a recent Bloomberg survey. However, they're still integrating what ESG stands for in their work, the same survey showed. And it comes at a financial cost to ignoring ESG on Wall Street, making headlines from the UPS labor strike to Hawaiian Electric being sued for its alleged role in the deadly wildfires. Here to discuss this more is Bloomberg's Eric Roston. What are you seeing in terms of how this kind of frustration or even hate, really, sometimes with ESG turning into conversations with investors and bankers, with the clients, after so much popularity just a year ago?
There's a great bubbling up. We have a number of systemic problems, and the stress created between investors and companies, between employers and employees, is creating the display of these systemic problems. You see it like with the UPS strike, which was resolved, but it's going to cost the company a little bit more than anticipated. There's losses involved. FedEx is seeing it too. It's very easy to talk about, the specifics of inequality, the generalities of inequality, the generalities of climate change, but when it hits the street, it is difficult to deal with.
Maybe double down on the financial cost, particularly with the S part in ESG, the social, given this is the summer of strikes. How is this floating across corporate America, and what's the toll being taken, whether it's a corporate brand or for investors' bottom lines?
The most obvious cases are ones that hit us every day, whether it's the package delivery services under labor pressure or or Hollywood with the writer's strike that's been going on. Again, it's more than a decade ago that the Occupy Wall Street demonstrations first brought to public attention, the extreme difficulty that many people are having with what they, perceive of, and this largely is, great growth in inequality. And again, even though that's been in the air, it is coming to a head now in ways we haven't seen in decades.
What has been the reaction from investors from Wall Street for the E part of the equation? Because that was really the vantage point. This is really the forefront of the ESG movement. Has it been getting as much pushback as the social parts have been?
I don't think so. I think once a term like ESG enters the political sphere, it's riding certain currents in American politics now, and I do think that the social leg of the stool is sort of slid more comfortably, if that's the right word, and it's almost certainly the wrong word, into American politics. Companies know that climate change is here and is causing damage. daily, it seems like, and I don't think there's any disputing a string of 30 days in Phoenix that are, over 110 degrees, or, the flooding in Vermont. It is in everybody's face. The United States has legislation now to articulate and fund approaches to solving the problem. So I think you're right. There's a real stark divide these days between the E and the S.
Eric, thank you for your time. That is Eric Rawson on some stresses on the ESG industry. Coming up next, we're going to pivot to earnings with New Construct CEO David Traynor. Up next, this is Bloomberg.
Connection lost.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
I'm John Hogan. Welcome to Bloomberg Markets.
And I'm Shonali Bassick. John, let's take a look at the S&P 500 because you are back in red territory. We were green for a second, but we are back to red. We are looking at a NASDAQ 100 that is also about 0.2% down on the day. But I will note out that this is the third day of pressure on both indices, and the NASDAQ 100 is about 6% lower than the summer high that we saw in mid-July. It's really a yield story, though, and you're looking at the 2-year yield just about 1 basis point higher. But the 30-year yield, the longer ends of the curve, is really where you're seeing the movement. You're looking at about 6 basis points on that 30-year yield. You're looking at a 441 handle and a lot of ramifications for this higher for longer narrative that is now being constructed once again.
And it feels like, Shonali, in an environment where everyone's taking a cautious approach, there do have to be some standout stories to have stocks on the move. Cisco is one of those. It's been the best performer in the Dow today. It's up about 4% after their message with their quarterly results and their outlook was that there is some resilient demand for their business. Moving in the other direction right now, CVS Health under pressure to the tune of 9%, with a key California insurer moving away from their Caremark business. We'll continue to track that developing story. Certainly the industry has been taking notice. And certainly if you have a business that gets the index notice, that can help out as well. So for example, today you've got a stock like Chesapeake Energy. It's up about 5% on news that will be added to the S&P Midcap 400. And then Ballcorp, which is selling a key aerospace part of the business to BAE, and that deal, a sizable multi-billion-dollar transaction getting the market's attention. It's up close to 3% on a somewhat cautious day overall for these markets. Shonali.
We're going to chat more about the markets here. Pretty soft on the day. We're going to talk to New Construct CEO David Traynor. David, if you look at the days of softness we have seen in the market, the S&P flirting between red and green today, is this just a summer lull, or is this a harbinger of a tougher September ahead of us?
I think it's a harbinger of a tougher September. I think the market's really finally digesting the fact that we're stuck with higher for longer, and that's going to slow the economy down. It's going to slow consumption. It's going to have the effect that the Fed has been trying to have for a long time. There's a lag between when interest rates are raised and the effect on the economy, and we're just catching up to that, both in terms of what's happening in the real economy, spending, as well as investor sentiment.
David, I want to get your perspective as well. We were talking earlier with the longtime Bay Street and Wall Street economist, David Rosenberg, who generally does take a bearish view. But I want you to hear a little bit of what he told us earlier today. A fairly skeptical outlook. Have a listen.
The recession has been delayed, has not been derailed. Normally it takes 2 years, actually, after the first rate hike by the Fed and the start of the recession. 2 years. They started hiking in March of 2022. So we probably have a bit more of a lifeline. This recession is staring us in the face, depending on your time perspective. We're not getting out of this without a recession.
And David, he made those comments in part because, you know, you did have that narrative recently that Jay Powell's own Fed economists were pushing away from the idea of a recession. Bank of America had been pushing away from the idea of a recession. So what's your economic outlook from here?
I mean, I have to agree with David Rosenberg. I mean, he's sort of saying exactly what I was saying, is that it's inevitable, it's coming. And look, I think this Goldilocks idea that there would be this sort of soft landing or perfect sort of scenario of slowing but not recession and everything kind of super good. I mean, that's sort of like a meme stock theory, right? It's just not possible. There's been an enormous amount of malinvestment or overinvestment over the last 10 to 20 years, where super cheap capital has led people to be less discerning and not make investments based on real fundamentals. People don't really even understand what fundamentals are most of the time. A lot of people don't even care about fundamentals. I mean, think about it. Bored apes, right? When's the last time you heard someone talk about reading footnotes? It's not nearly as interesting as crypto, NFTs, or AI, right? We've been such a narrative-driven market. People have forgotten what it means to be discerning, do their homework, and recognize that capital allocation decisions are difficult and take rigor. And, you know, the economy is going to suffer for, I think, a while as it works through all of the malinvestment we've seen.
I guess one of the points that maybe people who are a little bit more bullish might highlight, you know, we were just talking about Cisco's guidance today, Bloomberg Intelligence putting together the overall guidance picture for this quarter and determining for the first time in about 6 quarters, you saw the guidance topping expectations. So you sort of take that piece of the pie along with these better than expected results in the quarter itself. I mean, for you to see guidance that is relatively upbeat, does that perhaps justify some continued interest in the equity market from here?
John, I'm not trying to say that like we're headed to the end of the world. I think we've just got to be more discerning. There are plenty of really great, cheap stocks out there, great fundamentals, super cheap valuations, plenty of opportunities. The point is to be discerning about where you allocate capital and also about, you know, market expectations. Look, the guidance game, right, is just like every other Wall Street game. they keep lowering expectations ahead of the earnings, and then all of a sudden when it's a beat, you really have to recognize that sort of, you're beating already beaten down numbers. That's part of the game that's been going on for decades, right? Wall Street analysts know that if their buy recommendations beat the number, the stock goes up. So what do? They have extra low numbers so that there's a better chance for the company to beat. Same is true with guidance. So I think you have to take all these numbers with a grain of salt and do your own homework in terms of understanding what's really driving the numbers, because a lot of times what we see from the companies or even Wall Street estimates, those numbers are omitting a lot of really important information that can reveal very different operating and profit results than what investors think.
Now, David, I want to pull up some research here from the San Francisco Fed, because if you look at the excess savings that the San Francisco Fed is looking at across the country, they're telling you that aggregate excess savings would likely to only support household spending until the fourth quarter of 2023. What kind of cliff does that create for consumer spending, propping up some of these companies that we're reviewing today?
Yeah, I think, this is straight out of what David Rosenberg said a few minutes ago. And what I was saying before is that, there's a lag between when the Fed raises rates and we see the impact in the economy. And I think we're going to probably see the impact of excess savings going away for sure in the not too distant future, not to mention all of the additional liquidity that the government has been pouring in with respect to deferring payments on rent and deferring the limits on unemployment. So all these things, sort of the leftovers, stragglers from the COVID emergency funds, they're just now really being pulled out. I think we're going to see the impact of those being taken away here towards the end of the year too, and that's going to change the dynamic as well. And look, this does not mean we're talking about the end of the world. It just means that the meme stock phenomenon and some of these super overpriced stocks, there could be a lot of pain for people who've not done their diligence and make sure that when they go with FOMO or another technical strategy, it's driven and supported by fundamentals, not just the FOMO.
David Traynor of New Constructs, thank you so much for your time.
Thank you.
Coming up next, we're going to talk about Walmart raising its profit forecast yet again, but striking a cautious tone on the consumer outlook. More on that next. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets. I'm John Oakman with Shonali Bassick. Time now for our stock of the hour. We're watching Walmart today. Investors shrugging off the company's latest financials. Walmart, though, flexing its retail muscle and its grocery advantage in the quarter. But you have to keep in mind, Shonali, this stock has done relatively well this year, and that may have set a fairly high bar for investors.
Fairly high bar, and there's another man with a higher bar. It's Greg Mellick. He is an analyst at Evercore ISI. He has an outperform rating on Walmart with a price target of $175 a share. Greg, when you look at some of the troubles that you're seeing at Walmart today, the market is not loving this outlook on the U.S. consumer. What is the biggest downside risk to Walmart when you think about what they've said about how weak the consumer can get heading into this next part of this year and into next year?
Well, just because I think today the stock is down because the expectations were high. I think we knew that Walmart was doing well. We thought they would end up beating and raising for the full year. They did that, but clearly people were positioned for a nice beat and raise into today's print. More fundamentally for Walmart, we think the key here is that they are growing traffic again, and that's why we upgraded it back in March, and it's now in our top 5 portfolios. We think this traffic turn is real and has sustainable legs, and it's going to help them gain share and grow margins again, which they really haven't done successfully for many years.
And Greg, I think a lot of people understand that the way this business works and the scale certainly helps to keep prices low, but getting people into stores thanks to the grocery business and then maybe finding some good deals. What we are getting more guidance on, and we saw it in the quarter today, was the e-commerce part of the business, the digital part, the loyalty side, which they've invested quite aggressively in for the last few years. Should we be paying more attention to Walmart's e-commerce battle with Amazon and their ability to fight back on that front?
Absolutely. I think that what Walmart has been doing the last 5 or 10 years is really a lot of back-end investments that have come together at a time that people went back to regular stores, and then post-COVID, and now with a lot of strain on the consumer, are looking for value, and Walmart is the natural home for that. And so what's happening is with the investments they've made in multi-channel, they're winning new customers, they're winning more higher income customers, and I think the key of getting that e-commerce and really omni-channel to work together is that it's opening them up to a new customer base that really never appreciated Walmart because they didn't have a store nearby them.
Bring this all together for us, Greg, because we've had Target surprise. Walmart is doing just fine despite some weaknesses in the consumer coming up ahead. What happens next? Is the consumer holding up better as planned, or should investors still be concerned that there are vulnerabilities to some of these big box retailers?
We think that retail sales, after having spent 3 years running well above trend, basically growing close to 30% the last 3 years, the fact that they're going to decelerate to around 3% growth this year, we think is just back to normal. Frankly, we ran around 3.5% for the prior 20 years. So the real question is not are we coming back to something more normal, so do we have to go below that normal as inflation hopefully ebbs? And if we do, how long do we need to be there? We don't think we have to have a deep nominal retail recession. We think we can normalize. We think the back half of 23 will be the trough for U.S. retail sales, growing a little over around 2.5%. And then hopefully next year we'll get a modest reacceleration. But the key there is we have a lead indicator we look at, and number one is jobs. If you can keep growing jobs, we think that we're probably about facing the toughest pressure on retail in the next 6 months.
I guess just to build on Shanali's question, Greg, in terms of what Walmart can gain in terms of market share in an uncertain period, and we've obviously watched over many recessionary periods how they're able to keep that core consumer base. Are you suggesting that with that e-commerce arm that they are in a position to grab some retail share during this period of uncertainty?
Yes, I think that's what you saw both in the first quarter and now the second quarter print, is that you got Walmart comping 7 then and now 6.3. Maybe it's decelerating a little bit, but frankly, U.S. retail sales growth decelerated more second quarter from first quarter. So, Walmart, that's to me is showing that with this growing e-commerce prowess, Walmart's able to reach more customers, grab a bigger share of their wallet, and whether we're in a trade down type economy or in a recovering type world, winning new customers is always a good thing. And if you can wow them not just on value, but on convenience and assortment, which is what they're seeing and what they're doing, then you can keep those customers that maybe came to you to save some money when things are tough, but then when things come back, they're going to stick with you because of the great assortment you have and convenience.
Okay, so Walmart 156 today, it's trading at. Your target is 175. What gets it there, Greg? What is the single biggest kind of growth driver here for Walmart moving forward?
Single biggest is traffic growth, which is growing share both versus their competitors in retail, both Amazon or Walmart or Target. And as you get the traffic growth, then the margins we think troughed last year, and that inflection in margins with growing traffic is why we think the street's still too low for this year and is still below $7 next year. We think eventually they'll make more than $7 next year.
Greg, good to have you with us. Thanks for the breakdown on the Walmart quarter. Greg Mellick of the Evercore ISI team joining us. Time for a quick break. When we come back, Ken Griffin's influence in Florida going straight to the governor's office. We'll dive deeper into that developing story next. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg Markets. I'm John Oakland with Shanali Basic. Let's dig deeper into our Bloomberg Big Take today. An exclusive excerpt from Zeke Fox's forthcoming book, Number Go Up, Inside Crypto's Wild Rise and Staggering Fall, in which he uncovers a crypto-powered human trafficking ring in Cambodia. And Zeke joins us now to discuss. I mean, what a fascinating journey you take us on, Zeke. Not just with the crypto confusion, but also in the world of human trafficking. Did you ever imagine when you went down this road that this is what you would find?
No, I mean, this had to be the craziest story that I've ever seen in my career. And it actually just started with one of those wrong number text messages that we all get. It said like, hey, David, this is Vicky, like, what's up? Which is obviously not my name. And I just decided to play along. And it turned out that these texts are come-ons for crypto scams. They try and convince you to trade with them. And then people really send huge sums of money and it all gets stolen. But then the really crazy part is the people who are on the other side of the phone sending these messages.
Let's talk more about that, Zeke, because if you cover crypto especially, I think you get a lot of these messages. My own Signal and Telegram is kind of unbearable to look at these days, but I never tried to look at what was on the other side. Who is on the other side? Where are they coming from? And how do they not get in trouble for stealing this much money?
Yeah, so it turns out the messages are mainly sent by people in Southeast Asia who are themselves victims of human trafficking. There are like whole office buildings full of people who are threatened with beatings, electric shocks, or even death. Chinese gangsters are often running these places, and these crypto slaves are spent working around the clock sending these spam text messages to you. It's truly, truly awful. And for number go up, I went to Cambodia to check out some of these human trafficking crypto scam compounds.
Zeke, that is truly terrifying. We wish we could get into it more, but we are going to make people instead read your book. Zeke's Number Go Up is available on September 12th, wherever you buy your books. Another Bloomberg exclusive today looks at Ken Griffin lobbying in Florida, particularly when it comes to anti-China crackdown on foreigners, buying property in the Sunshine State. Bloomberg's Miami bureau chief Felipe Marquez is here to explain. Felipe, if you take a look at the incident itself, what does Ken Griffin have to gain by fighting Ron DeSantis on these policies in particular?
Thank you for having me. Basically, to Ken Griffin, Ron DeSantis' ban on Chinese and other seven countries of concern of owning property in Florida, he saw it as an ideological affront. So to Ken Griffin, lawful workers should be able to own real estate whatever they want. And in one of the most extreme versions of the law, even if you had a working visa, if you have a green card, you wouldn't be able to actually own property in South Florida. But there's also another side of it. You have to remember that Citadel has relocated to Miami last year, and they're bringing in hundreds of workers to Miami, which would, so a law with that kind of impact, a law with that kind of restrictions would obviously impact some of the workers in Citadel. So he actually also prevented that from happening, or could have impacted some of the workers from Citadel.
And as the team's reporting highlights, I mean, there are some very personal aspects, Philippe. The fact that one of his trusted deputies is a U.S. citizen who was born in Beijing. But in terms of having an impact in a political related fight, is this all Ken Griffin? Is it part of a wider group effort?
Okay, so it's not necessarily just Ken Griffin, but he is obviously the most emblematic opposition to this law, but we have seen opposition from groups that have tried getting overturned in courts. We have seen opposition from rights advocacy groups. There's been widespread opposition by some of these groups to these particular laws. And it's also not just Florida. You have to remember that this is a concerted effort by Republicans in other states as well, who have been trying to ban Chinese and other countries of concern citizens of buying land, especially near military installations.
Talk more about the relationship between Ken Griffin as well as Ron DeSantis. Remember, we have to remember that he donated $5 million to the re-election campaign for Ron DeSantis to become governor again. But there have been signs of tension. How significant are those tensions, and does it signal a waning support from the billionaire to the Florida governor?
Okay, so to answer that question, let's think about a little bit how things have shifted, right? So last year, DeSantis wins this landslide governor re-election. Ken Griffin was one of the main backers, gives him $5 million, says he would like to see me run for president. That's the state of things basically end of last year, beginning of this year. Fast forward to now, there's been a clearly cool off. You have to think of where DeSantis is right now. He launched the presidential bid. He's down on the polls, way behind Donald Trump. He has reset his campaigns, I don't know how many times by this point, changed the campaign manager, so there's clearly a lot of issues in gaining traction. Meanwhile, and he also supported a lot of very controversial things. You have to remember the restrictions in abortions, this law we were talking about, a crackdown on immigration, and that has alienated some donors. One very important piece of data here. Griffin donated $5 million to his re-election campaign as governor. He hasn't given him a cent for the presidential campaign. So there is some sort, there is a tension in the air here.
All right, Philippe, thanks very much. Philippe Marquez from the Miami Bureau on the Ken Griffin efforts in Florida. Shanali, I mean, look, this is a story that you've covered, the transition of Ken Griffin from Chicago to Miami and now dealing with a new number of issues on his plate here.
Yeah, and you're talking about Florida. Earlier today, we were talking about New York just committing more of its office buildings over to residential real estate, and I think that's interesting because the tension, the dispute, the wars between New York and Florida, they just keep hitting up, and that is a place that billionaire, among many others, have a lot of space to hold.
Absolutely. And for Shanali and myself, this is Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
An uptick in volume, but not necessarily an uptick in price. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell. Here in the U.S., you take a look 2 hours ago. It's another down day for the S&P 500, for the NASDAQ 100. We start with the S&P off by 0.2%. It was a little bit higher, a little bit earlier, but now on track for a third day of declines, as too is the NASDAQ 100. You go down the list, of course, a lot of this stress is emanating from the bond market, where that sell-off continues. You take a look at 10-year yields right now above 430, adding 7 basis points today alone. And it's the long end that's rising more than the short end. That has been steadily working its way through the 2s-10s curve. You look right now, still deeply inverted, about 66, 67 basis points. But Romaine, we know that number was below 100 not too long ago.
Yeah, absolutely. Here, a lot to parse here on this Thursday afternoon. One sector our viewers should keep an eye on is in the pharmacy space. CVS, those shares plunging to the lowest levels that we've seen in about 3 years. This after one of California's largest health insurers said it's going to drop CVS's Caremark unit as its main pharmacy benefit manager. But here's the kicker. The insurer said it would work with a group of companies relatively new to the pharmacy space in order to lower costs. It includes Amazon, and it includes Mark Cuban's drug venture called Cost Plus. Investors looking at this as more than just a shot across the bow of the traditional pharmacy providers, and really more of a cannonball shot to the whole. Cigna having its worst day since August 2021, Cardinal Health having its worst day since early 2022, and GoodRx, which remember, just last month launched a savings program with Caremark, plunging as much as 10% here on the day. Keep an eye on the healthcare space, and guess what? Keep an eye on the crypto space. Bitcoin, remember Bitcoin? Well, it's back. It's been in a relative stasis for the past couple of months, but a big breakout this week to the downside. A fifth day of declines, with today being the worst down, as much as 4% down below 28,000. Similar percent declines today for Ethereum and some of the other major tokens. No real news driving the moves, but it is plausible here that the uptick that we've been seeing in sovereign debt yields worldwide might actually be a factor. So let's take a look at some of those yields, Katie. The U.S. Treasury sell-off now in its 6th day. We're up about 30 basis points over that stretch now, highest levels since 07.
It is getting real. You take a look at a weekly basis on the 10-year Treasury yield. We're looking at 4 or 5 weeks of straight upward moves. So far this week, we're already up about 17 basis points on that benchmark 10-year yield, above 430, looking at the highs from last October. We'll see how high we can go. And of course, as we talk about how high yields can go, that has cross-asset ripple effects, and you've really seen that in the stock market, especially in the big tech stocks. If you take a look at the NASDAQ 100, it's getting interesting. You have the NASDAQ 100 in white here, and then you have this blue line is its 2023 uptrend. We are getting pretty close to breaking it. In yellow, you do have the 200-day moving average. A lot of daylight there, but with the speed of these declines, maybe we could be testing that. But Romaine, a lot of that lies in the bond market.
Absolutely. Let's kick things off here. The kickoff to the close begins with Rebecca Patterson, former chief investment strategist over at Bridgewater Associates, joining us live here in Studio 2. Rebecca, great to see you.
You too.
Always great to have someone with your wealth of experience here on the program, particularly in kind of an inflection point, I think, in the markets and in the economy, where even the smartest people don't seem to understand where we're going to go next. So I have to put you on the spot and say, where do we go next, particularly in terms of what we've been seeing in the sovereign debt space, and what are those yields telling us?
Yeah, certainly the increased supply that the Treasury has told us is coming in the bond market, the Fitch downgrade for the United States, Japan starting to tighten policy, which means it might have less demand for foreign assets, including Treasuries. All these are factors, but the one that makes me think that maybe the upside for bond yields from here is more limited is where we are in terms of the sentiment around the U.S. economy. So Citi has something called the Economic Surprise Index. It measures positive, negative surprises versus consensus. It's been rising since May, and we're now at a 2.5-year high. Bond yields track that intuitively, right? As sentiment's improving, that gets reflected in longer-term yields. But these things are mean reverting. When economists see more data that's like, oh, we weren't bullish enough, eventually they raise their forecasts, and then the surprises start disappointing. And I think that's what we've seen for the last 20, 30 years since these indices existed, and I think that's probably what we're going to see in the months months to come for good reason, right? Things like student loan payments coming back to bear,
right.
Households running down their excess savings, starting to pile up more credit card debt. All this will work together and I think put a cap on yields. I don't know if it's today, next week, but I think it's coming sooner rather than later.
But when you say that, does that sort of mean, am I to interpret that economic conditions will get to the point of crossing that threshold into recessionary territory if we haven't already? Or can we just maybe have a soft economy that's not necessarily a recession one?
I do think obviously the Fed is trying to navigate a soft landing, not over tighten and allow us to take some of the air out of the balloon that the economy is today. And it's a question mark if they get there. If I had to put a number on it, I'd probably be 40% soft landing, 60% mild recession at some point into next year. So that's where I sit on this. But I do think with the bond market and bond yields in particular, it's not just the absolute level of growth, it's what happens versus what was expected. So downside surprises, even if the economy is doing okay, can be enough to start bringing yields down or at least putting in a ceiling.
Well, that's what I'm really interested in. So your expectation, of course, 40% soft landing, but you think about what the bond market is pricing, and especially at the long end. Is this the recession trade basically getting priced out and maybe a soft landing trade getting priced in?
Well, that's exactly right. And I think that is part of the reason we had seen this nice run up until very recently in equities as well, and a broadening in the equity recovery was people saying, okay, it's time to get back into cyclical sectors, et cetera. But when we look ahead, what is going to be the impetus for that to continue to the degree it's priced? I mean, already for 2024, the market's discounting that we're going to have double-digit earnings growth on the back of Fed rate cuts and a still strong consumer. What is the probability that all those things align and it's still priced in? So we need to do even better than that to see equities really go up again next year. So I think the soft landing is discounted. So the bias of risk is that we don't quite live up to the hope, i.e. we get disappointed on growth and equities, maybe not down, maybe not a bear market, but certainly not as good as what people are now expecting.
I'm really glad you brought equities into the conversation because for so long it felt like equities were just marching to their own tune. They weren't really paying attention to what was going on in the bond market. And now it's almost at a point where it feels like bond yields have started to matter, maybe to valuations. Is that your read when you look at that dynamic over the past month or so?
Oh, certainly. I mean, when we're looking at the cost of capital, you care about the short end and the long end. Certainly things like tech stocks, things like Bitcoin, which I would call fintech.
Okay.
Part of the reason those things are getting hurt right now that you just mentioned a few minutes ago is because it's part of the tech ecosystem. Profits are further out into the future. Cost of capital further out matters.
Yeah.
But I think we're also seeing this broadening out to every asset class. You look at the strength in the dollar. You look at weakness in emerging market currencies and developed market currencies in the last month. These are all tied, not completely, but in large part to what's going on in rates.
Well, let's talk a little bit more about that. I mean, I was taking a look at the main MSCI index that tracks EM currencies. I mean, we're basically kind of at the lowest levels of the year, give or take maybe a couple of days that we had back in February. And I am curious as to the driver of that, if it is just all rates, if it is economic conditions, and more importantly, how much of an outsized influence does China and its troubles play into that?
Yeah, I mean, I'm thrilled that we're going here because today, 25 years ago today, is when Russia's ruble defaulted, or Russia defaulted and the ruble was devalued. I happened to be a currency researcher in London on that day, so I remember it very well. But what I think is interesting today, you don't have as much EM positioning, so you don't have as much capital flight out, but China is a much bigger deal for the global economy and markets today. So what happens in emerging markets absolutely matters. The Indian rupee is near an all-time low. The Russian ruble down 9% in a month. Chinese renminbi weakening despite intervention. You're going to have contagion from this. I think the question is how much. And in 1998, when the Russian ruble devalued, the Fed within a month was cutting rates 3 times in 7 weeks. Today, with core CPI at 4.7%, they can't pull that trigger. So they're going to have to use other tools in their toolbox to help if we have a contagion risk. And I think that's something investors need to spend a little more time on right now.
Well, I'm curious, just real quickly here, we only have a little bit left, but I mean, you bring up the crisis back then, and of course we know the fallout from that. There was a lot of contagion, but that contagion, and correct me if I'm wrong, it was largely confined to the developing countries, and we know that there was some hit here, but it was relatively short-lived. Do we need to be as worried now with China stumbling that that whatever is going on there maybe potentially just gets confined to EM markets.
Yeah, I mean, in 1998, yes, most of the pain was in the emerging markets, but it definitely trickled into the developed markets as well. I mean, anyone who remembers LTCM, that was a direct response to the volatility that happened on the back of Russia. So there was definitely a hit in the United States. But I'd say today what's different is just the footprint China has. The global shadow it casts is so great. And when we think about Fed still raising rates, maybe they're done, maybe they're close to done, but liquidity is draining. Quantitative tightening is continuing. So we're still seeing those conditions happening. What could break? You know, we've already had our worries over banks, over commercial real estate, private credit. Could emerging markets be the next shoe to drop, and could we see some fallout from that? Remember, it doesn't take much. Cyprus, Iceland, right? The butterfly effect means that you could have some small thing be the camel, you know, the straw that breaks the camel's back, so to speak, especially in August when we don't have much liquidity.
All right, Rebecca, I can talk to you for another hour about this. Always great to have somebody, a wealth of experience from the 1998 ruble crisis to today. Rebecca Patterson, former chief investment strategist at Bridgewater Associates, helping us kick you off to the closing bell. Coming up here, a sit down with the CEO of Tapestry, the luxury brand, out with earnings just a little bit after we learned about the potential tie-up, Katie, with Capri.
And we're going to look at Walmart. It raises its profit forecast again, but the company strikes a more cautious tone on the future of the U.S. consumer. We'll take a look at why.
And ChatGPT, no, it's all about, what is it, GLP-1? All the hype over AI has now switched to hype over weight loss drugs. We'll explain why it's popping up on everyone's conference call, even those that aren't in the pharmaceutical industry. Now, all that and more coming up in a bit. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Season is here.
Another crazy busy week.
There's still a lot of uncertainty. The market knows that there's bad things coming.
Bloomberg breaks the numbers first.
A slew of earnings.
Some breaking earnings.
What did we learn from earnings? I mean, a lot of them beat. Some of them got slammed.
With exclusive expert analysis.
This is a growth story. Advertisers are pulling back.
It certainly will be a headwind.
Good revenue growth across the globe. A record year.
We haven't seen a result like that since a decade.
We're not standing still.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
More difficulties facing China, the currency there under pressure, and Bloomberg has learned that Chinese authorities are telling state-owned banks to step up intervention in the currency market this week in a push to prevent a surge in yuan volatility. Joining us now to help break it down is Bloomberg Economics senior geoeconomics analyst Gerard DePippo. Gerard, great to have you with us. It feels like every single day this week we've woken up to new news about China stepping in some way to support their economy. What do you make of this latest round of intervention?
Well, it appears that the PBOC is telling state-owned banks to intervene on its behalf, including in offshore markets. Basically, I think what the PBOC is trying to avoid is any direct intervention. So if you look at the PBOC's balance sheet, it doesn't seem that they're actually spending their own reserves. Instead, they're trying to use sort of window guidance and administrative measures to stem the slide. The thing that we've observed over the past 2 months or so is that the PBOC is setting its daily fixing rate for the exchange rate. So that's basically sort of what the trading band that establishes trading each day. They're setting that stronger than market conditions would suggest. In other words, they're trying to sort of guide the exchange rate stronger, but without using a lot of direct measures. But it's possible that state banks are actually doing selling of dollars on their behalf.
Gerard, just put it in context here for our viewers, too, particularly when it comes to some of these financial trusts, the kind of relatively opaque, but about the way that they pool funds and the way that those funds then get deployed and why that in and of itself becomes a big part of the issue.
Right. So China has things called trusts, which are part of the shadow banking sector. They're not banks. They sell financial products basically to rich Chinese and firms. They often pool that money and then they invest it in loans, often sort of in higher risk assets, promising at least 6% returns. The pooling issue you mentioned is risky because what they ended up doing is often taking money from one set of investors, using it to pay out the redemptions on a previous financial product. So there's kind of a rolling payoff scheme. The Chinese government tried to stop this a few years ago, but the rumors are it still continued. And Zhongrong, which is a well-known trust, has defaulted on maybe 30 or more financial products in recent days, which sparked some protests in Beijing.
And Gerard, is there a line that can be drawn between what we're seeing in the shadow banking sector in China and China's real estate sector?
I think there can be. So the trusts generally invest in riskier assets, as I've said, and Bloomberg Economics estimates that maybe 10% of their direct exposure is to real estate. Indirect might be higher than that. The trust sector in China has assets of about $3 trillion equivalent. So if about 10% is direct real estate and there's other things like, for example, they provide maybe more than a quarter of the financing that property developers are getting, there's all interlinkages, right? So much in the Chinese financial sector is built around either lending to the property sector or property as collateral, and trusts are no exception to that.
All right, Gerard, got to leave it there. Really appreciate your insight. That is Gerard DePippo of Bloomberg Economics. Coming up on the close, an exclusive interview with the CEO of Tapestry just days after the Coach parent announced the acquisition of rival Capri in a deal that would create the world's fourth largest luxury
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Well, we do have some breaking news on the terminal right now. Goldman Sachs plans a hiring spree to fix lapses. That's amid the Fed's scrutiny. Just to repeat that, Goldman Sachs planning a hiring spree to fix lapses as the Fed takes a look at the bank. We're going to continue to follow this story as we get updates, Romaine. But just again to reiterate, Goldman apparently going to be hiring to satisfy the Fed here as they continue to look into the bank.
All right, we're going to try to get some more details on that story. Meanwhile, one of the big stories of the day and really of the past week involves Tapestry, the luxury goods company, out with its latest earnings reports. This just after announcing that acquisition of a big rival, Capri. Joining us right now for an exclusive interview is the CEO of Tapestry, Joanne Crevoiserat, joining us. And Joanne, there's been a lot of discussion here about the tie-up that was announced with Capri, and I know that's still a long way coming before that finally gets done, and more importantly, whatever integration needs to take place gets done. But I am curious as to how you're preparing for that integration here. What type of overlaps are there, and how do you plan on addressing them?
Well, in many ways, Romaine, and thank you for having me. It's great to be here. We've been preparing for this for at least the last 3 years. We've undergone a fundamental transformation in our business to really focus on our brands and brand building, and really focus on engaging with consumers at a deeper level and meeting them where they are in an environment where the consumer shopping behaviors are changing rapidly. And we've transformed our business over the last 3 years and continue to perform, leveraging the power of our brands and the power of our globally diversified direct-to-consumer business model.
Right.
So all of that work that we've done have prepared us for this moment. We've been performing, consistently delivering earnings amid a very volatile backdrop for the last 3 years. So really showing the power of this model. And, we came out with earnings today, so I'd be remiss in not mentioning that we're operating from a position of strength.
Yeah.
We delivered record earnings per share, and we have a platform that we think is scalable, and we're excited about the acquisition of Capri to put those brands on our platform.
Well, give us a sense here of like what specifically applies. I mean, we've been talking a lot on this network about the big turnaround in Coach and some of the other brands under the Tapestry umbrella. We know that Capri and some of its brands, particularly Michael Kors, has a lot of catching up to do in that space. Why is whatever the secret sauce was that maybe helped Coach out, why is that secret sauce somehow also going to be applicable to something like Michael Kors or its other brands?
Because it's very clear today that the power of brands and engaging with consumers. And what's great about this portfolio and the potential that we see with the Michael Kors or with the Capri portfolio overall, first, we play in an incredibly dynamic and large market. It's a $200 billion market in the accessories, footwear, and apparel categories. And it's a market that's proven to be durable and resilient over time. So we love the place we play. And importantly, brands matter, and we're acquiring differentiated brands with clearly differentiated positioning in the market, and brands that give us access to new consumer segments and higher end luxury consumer, which is an incredibly resilient consumer. And as I said, the work that we've done over the last 3 years to transform our company is really to focus on brand building, number one. We have made that focus. We've made investments in being able to engage consumers in digital channels. That requires capabilities, investment, technology. We've made those investments, and we're ready to scale those investments.
Right.
We've also put data in the hands of decision makers, and that's enabled us to get closer to our consumer and acquire consumers, and importantly, acquire younger consumers, which is important for every brand in the market today. Yeah. We talked about, we just delivered our results. The customer acquisition we've done, half of those customers have been young millennial and Gen Z consumers this year.
Well, Joanne, let's talk about some of those brands, because as part of the portfolio that you're acquiring with Capri, you have Michael Kors. What are some of the things you're going to be prioritizing in Michael Kors' turnaround, for example? Are you going to hire a new creative director?
Well, it's certainly early to talk about our specific strategies. We're working very hard towards the closing of this transaction, but I'll tell you what we saw. We've done a lot of work leading up to this transaction in true Tapestry fashion. We're data-led, right? We've done a lot of research in the market. These are strong brands, including Michael Kors. They're strong brands. They're well-positioned in their market with unique and distinctive customer segments. That's a great place to be, to start with brands that have tremendous awareness and tremendous brand equity. That's a great starting point. We think as we take the learnings that we've had over the last 3 years and the investments that we're making, remember, we've doubled our marketing investments over the last 3 years in our own portfolio, right? We've developed the capabilities to reach consumers where they are. So that is the focus we're bringing to the brands. It's too early to talk about leadership, management, all of that. We see tremendous runway ahead, and all of that is in front of us.
Well, Joanne, we're up against the clock, but I am curious if you're worried at all about regulatory scrutiny here as you try to close this deal.
Well, we're confident in our ability to close this deal. And as I said, we play in a very fragmented, large market, $200 billion market, very fragmented. And as I said, this combination, one of the best things about this for Tapestry, it's a highly complementary acquisition in that it stretches our reach into new consumer segments, and it's complementary from a geographic perspective as well as at product categories. So they have strength in product categories that we can learn from. They have strength in geographic regions that we can leverage, and vice versa. So we're excited about the opportunities ahead.
All right, Joanne, really appreciate you taking time for us. I know you've got a lot of work ahead of you here. Joanne Kurvoy-Sirachi is the CEO over at Tapestry. A lot more coming up here on the program with the eye on the broader markets on the back foot for the most part to start the day. Right now camped out around session lows, an uptick in yields with the 10-year right around 4.3, 6 basis points higher here as the sell-off in Treasuries enters and begins a 6th straight day. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Welcome back to Bloomberg Markets to Close. The most read story on the Bloomberg terminal is a story that just dropped about 10 minutes ago. It's on Goldman Sachs and involves, well, the potential for a back office hiring spree as Goldman Sachs seeks to address some of the concerns about regulatory scrutiny. Sri Natarajan joining us right now, the co-writer of that story. And Sri, explain to us exactly what's happening here. Hundreds of potential new hires, primarily though in the back office and primarily to address some of the regulatory issues that have been raised.
Look, the most important thing to acknowledge is it's never good to have the Fed in the building and definitely not in your business. And that's what's been happening at Goldman Sachs. Over the past year, we understand that there has been ramped up Fed scrutiny from their banking supervisors that are trying to remediate what they see as lapses. We, of course, know that their consumer business, their credit card practices have been looked at by the CFPB and other government agencies, and we know that the Fed had been asking questions on that. But this goes beyond that. There is clearly, apparently, a confidential measure at Goldman that has been looking and asking Goldman to fix lapses, identifying problems, and is seeking corrective action. That kind of thing, while not public and not formal, can be onerous. And if you don't address it quickly enough, it can spiral into something much bigger, which is why it is a headache for them. And that's why you now see several hundred staffers being hired to address that right now. Just to give you some context, if you go onto the Goldman website right now, there are more compliance job openings there than for bankers and traders at the firm.
Well, that's one of the many interesting wrinkles here is that Goldman had been cutting staff. It had laid off thousands of workers, but now obviously having to reverse course a little bit.
And that's also important. So why have they been laying off workers? Why have they been cutting staff? This year to date, through the first 6 months, profits are down 35%. That is after profits being down 48% last year. So clearly there has been a slowdown in business. Clearly they're dealing with an inversion in markets. So at the same time, is it helpful to have a new cost center where you're just dealing with remediation efforts? No. But when you hire people in these roles, these are not people who are going, this staff is not going to be paid like your typical Wall Street rainmakers. But that's not the point. Having them in the building and having them oversee some of the issues can also have other stifling impact. It could have an impact on the kind of deals you can do, the kind of trades you can do, and how you win more business. And there is only so much management bandwidth. We already know Goldman management has been dealing with a lot of stuff. This is just another extra thing on their plate that they don't need right now.
All right, Sri. Oh, do you have another question?
No, go ahead, get it.
All right, well, I'm going to goodbye you because I'm sure you're very busy all over the breaking Goldman news. As always, that is Sri Natarajan, who just broke that story. Now let's get back to earnings because there's a new buzzword popping up all over company earnings calls. It's not AI, though. We're talking about the new focus is GLP-1 drugs like Ozempic and Wegovy that are being used for weight loss. And Joe Weisenthal, he's the co-host of Bloomberg Odd Lots, of course, the podcast that has been tracking this story. He joins us now. And Joe, I was looking at the chart you had in your story about all the mentions. How many companies are we talking? How could it be mentioned this much?
Yeah, I mean, that's the interesting thing. So there's obviously like the makers of these drugs, and they're, people ask them about them on the call. Novo Nordisk, the big Danish company, obviously others have theirs in the works. But, when you think about, how prevalent obesity is and how many different companies have tried to sell some sort of like weight loss solution or like healthy snacks or something, you start seeing just like all of these knock-on effects, or like a surgical device maker that sells like stapling for like your stomach and other approaches that people take to lose weight. Like, it's surging the number of companies that this is that this is affecting, and it still feels like it's like early on.
It still feels early on. I think it just drew a lot of attention when Walmart sort of flagged it and basically said that this is actually going to change their retail mix and for the better, they seem to suggest. So they didn't point out that maybe their sales of snacks and stuff might actually fall if sales of the other things go up. I mean, we kind of put this in the context of all the hype we heard about AI and ChatGPT, and everyone just had to mention it. And that's just because they wanted to mention it, but they were going to be asked about it.
Yeah, a lot of these companies, it's the analysts asking them directly. I mean, I think what with the AI thing, it felt like, I don't know, AI is probably going to be a big deal, but it felt like it was one of these things that came up because the CEOs...
What's going to be a bigger deal, AI or weight loss drugs?
It's GPT-4 versus GLP-1 are the two acronyms with a number in them. But it feels like this is coming up because already there are material effects on the business. There's one company on their earnings call that sells some sort of weight loss solution. They're like, look, our cost of customer acquisition is going up because there are these competitive things. Where we don't see it yet showing up in the earnings calls are like this sort of like, it didn't show up on like the Wendy's earnings call. And so like it still hasn't really hit the point where like normal like sort of like sellers of consumer packaged goods.
When you say it's the Wendy's, you're thinking that Wendy's will take a hit because we're all going to be
Well, that would be the theory,
weight.
right? Because the way that these drugs work is they reduce your appetite. It's supposedly like, they really make people just not want to eat as much like fast food or something like that. So in theory...
That sounds awful.
I know.
Yeah,
That's what I know. And I don't want to ever live in a world where I don't desire to eat Wendy's.
Do you remember Jack LaLanne?
Yeah.
I remember like late in his life before he passed, rest in peace. He talked about how he hadn't eaten ice cream in like 50-something years.
Terrible.
And he didn't even need Ozempic or Wegovy or whatever for that.
That's just a true self-control. But like the fact that it came up today on the Walmart call, I think says something pretty big about like this is spreading really fast. And I think there's been this view, it's like, oh, it's really expensive or whatever it is, and it still is. But for it to be like starting to move the needle a little bit at a place like Walmart.
When is the On Lots podcast on this?
So we basically sort of, we talked to an investor, this guy, James Van Gallen, who had written a lot about it, just about this phenomenon of this is not just a story that's going to affect the drug makers themselves. It's going to affect insurance. It's going to affect benefits managers for corporations. It's going to affect all different kinds of entities. And you just see it. We have the, the document search function. If you have a terminal, you could just put in DSGLP1, and they built this page for us. It's really nice, and you can just see the number of companies each quarter bringing it up, and you can
Where's Tracy? Because she hosts that podcast with you. She's not here today.
She's walking out the door.
And what I love about Tracy, she always does the experiment, like when she bought oil and like kept it in her basement or
she
bathtub.
hasn't.
Now, is she going to take Ozempic and Wegovy? Take one for the team.
She has not given herself the injection.
I would read the diaries that she would write on that. I think we have to go, John.
We do have to. Can you come back soon, though?
Anytime. Anytime.
This was fun. Or Tracy. We'll take you there. Joe Weisenthal.
What about both?
Yeah, that would be fun, too. Right. We have another seat here. Anyway, Joe Weisenthal, co-host of the Bloomberg Odd Lots podcast. Of course, you can listen to Odd Lots on your favorite podcast platform, Apple, Spotify, or the Bloomberg terminal. Still ahead, though, Walmart reporting a second strong quarter. Still cautious, though, on how U.S. shoppers are pinched by pricing. We're going to speak with Bill Kirk. He is managing director at Roth MKM next. This is Bloomberg.
In global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
There is no digital without chips. And I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial medical